All right. Welcome, everybody. Welcome to Minus Investing Live. Give me a moment here. Looks like there's been some changes, updates to Streamlabs since the last time I streamed that it did not let me know about until I went live. Looking like the good kind, but it's like new features that I wasn't expecting to pop up. That's kind of cool, but here's hoping that it didn't disturb any other important settings or anything like that, but it doesn't look like it. It looks like everything is live. Looks like the sound is good. So welcome, everybody. Got a ton of stuff to talk about today, or a ton of potential stuff to talk about today. We'll see how much of it we actually get to today. Maybe we'll push some of it to other shows at some point in the near future. Watch out for my cat here. But yeah, so anyway, yeah, lots of stuff to talk about today. We'll see what we get around to and what we don't get around to, because lots of little stuff, and I'm sort of going to try to not stick with too much of those topics for too long. So maybe we can get to a lot of it, but we'll see. I know I've been saying this several times in my streams lately, but I am sort of trying to kind of work my way around to some sort of regular schedule. I know that it doesn't seem that way, but there's a lot of planning going on behind the scenes. I've definitely been working on all sorts of stuff, and trying to kind of create essentially a kind of schedule of sorts in terms of like what types of content I'll cover, what types of analysis I'll do, especially like a lot of the economic analysis I like to do. Since that kind of comes out on a regular schedule, I'm trying to kind of create essentially a regular pattern by which I will cover certain things and analyze certain things. And with that, I have been trying to build various models for how to analyze all sorts of different things. So like I think I kind of said that in my last stream. I was like, well, I have been working on lots of things, and hopefully I'll be showing more of those things to you guys in the near future. Well, I'm going to show you some of those things here today, and in addition to the various topics we're gonna dive into. But yeah, first off, I'll give you a good example. First, before we go into any of that, here is the portfolio as it currently stands. Not too many changes since we last talked about it. I have bought more FG since last time we chatted. I've bought it pretty much like every other trading day, I would say. I bought tiny amounts, not huge amounts, just little bits here and there, trying to kind of tap it up. What with our previous live stream, I know we did talk about FG in pretty significant detail, especially in relation to the kind of significant concerns about private credit, which kind of began roughly around the same time that this big decline happened here, which happened kind of after our initial pop from the last earnings. And so we are fast approaching earnings here this week. So I'm kind of hopeful that we'll get a pop on that too, but it kind of depends on what happens with the earnings. And I don't necessarily have a strong opinion necessarily about what's going to happen with like their actual core business with this particular earnings. But we'll see how things go with that. I was looking just yesterday at the preliminary estimates for the annuity market for the third quarter, which it did look pretty good. Third quarter, you can see here 119 billion was an uptick from Q2, just barely at 119 billion. Oh, here, hold on just one moment. My cat's trying to. Sorry, I had a cat trying to crawl into the blinds there. But as you can see here, it's really only just barely any movement from Q2. It's basically flat with Q2 for the most part, but it is an uptick from Q1. So that's good to see kind of some sequential movement throughout the year here, though we are on a little bit of a decline currently, relatively from the fourth quarter of last year, or not the fourth quarter, from the third quarter of last year. So you can see there was a little bit of a decline, 102, 106, and then back up to 119 billion. So there's been kind of some ebbing and flowing over the course of the quarters here, but we're potentially on our way back up to kind of some peak level of the total US annuities for that particular market. And then within that, there is the fixed index grouping right here, which kind of carries that trend even further. You can see that the Q3 is 33 billion versus 32 billion in Q2. I have to fight my cat. Apparently she is determined to get to my window. 33 billion in Q3 and 32 billion in Q2 versus 27 billion in Q1. And then comparing that to Q3 24, we have 35 billion. So you can see that the expectation is currently a little bit lower for fixed index annuities relative to Q3 24. However, you can see that that sequential increase in decline is a little bit different for Q1 to Q2, Q4. So overall, the improvement is better. The improvement is better than it was in Q4 in 2024. However, we still have to kind of make up that full lap on that. So that's one thing we'll see on that. What share of this in particular the FG actually gets, which is kind of the majority, not the majority, but the lion's share of their revenues. And then obviously there's other categories which they fall into, which includes fixed immediate, as well as registered index linked, variable, as well as their non-annuity, or I should say non-retail annuity categories, which includes the pension risk transfers and other institutional sales. So we'll see what happens with FG sales. I saw this report and I was like, okay, that looks kind of promising, but it doesn't really look super promising because, like I said, it kind of makes Q3 look about the same as Q2. FG on a relative basis in terms of like market share did actually kind of poorly. I shouldn't say poorly, but weaker in Q2 relative to some of the other players. So they stand the opportunity. While the overall industry didn't particularly improve in Q3 relative to Q2, we could see some improvement of FG relative to its other players. So we'll see on that front. FG did give some good arguments for sort of why they had difficulties with their pricing in Q2. So hopefully we'll see if that improves for them. Technically speaking, one of the things that they point out about that was the bond market volatility within the quarter, which you can see that over the last 3 to 6 months, bond market volatility has been declining. So theoretically speaking, if that argument that they use to kind of explain why that they had a little bit of a weaker Q1 and Q2 holds, then they should theoretically do a little bit stronger in Q3. Admittedly, though, that argument plays out for kind of their other competitors. So that's why I say it's you kind of have to double check on that argument. So yeah, like I said, topped off a little bit of FG. One thing I've kind of been gauging to kind of think about FG, especially in relation to those risks we were talking about. Obviously, they have significant relation to Blackstone, being that that's the major asset manager that they rely on, and Blackstone is one of the major players in the private market space. So FG, and so you can see like pretty significantly correlated, especially in the last few months, depending on the kind of what time frame you show it at. And obviously, yeah, big candle over here kind of skews that, but you can see they're pretty decently correlated. And in the last few months, especially when that decline began, they've been even more correlated. So Blackstone, you can see, has also not particularly recovered. They themselves already reported their earnings, which the earnings was relatively good. They had beats across the board, revenue, earnings, and also pretty strong, significant growth, inflows, realizations in their credit space. So overall, I felt pretty good about their earnings, and it didn't make me feel like there was any major concerns. And they themselves thought that people were making a really big stink out of something that's really not that major. And then also, there is the Blackstone Secured Lending Fund, BXSL, which is another security that you can look at. Which is a little bit more closely related to specifically the type of assets that the FG gets exposure to from Blackstone. So that's one thing I like when I found this particular instrument. I was like, oh, this is in many ways sort of like a proxy for specifically the product that the FG essentially gets exposure to from Blackstone in particular. So that'd be the green line here. And you can see like it's a little bit different. It's actually a little bit less volatile because it's essentially a bond fund, so to speak. Let me get rid of Blackstone as is and just kind of look at that one in particular. In many ways, the correlation actually becomes a little bit better. It's not quite equity like in the same ways. And then obviously there's this big bump up here, which has more to do with FG's growth, revenue growth rate expectations there. But especially once you get past kind of that bump, the correlation actually becomes even stronger, which the correlation broke down a little bit here, which was the period in which FG was diluting their share count. So that kind of explains why that was happening here. But then you can see it also has become highly correlated during this private credit scenario here. So one thing, like I said, I've been buying a little bit of FG every other day or so, every other market day. And I've kind of been looking at BXSL as I've done. I've kind of looked at like the performance of BXSL on the day, as well as the performance of FG on the day. And if BXSL looks like it's doing fine and FG is fine or even down on the day, then I'll basically buy a share or two or a couple shares, and then if BXL is down on a day, well, maybe then I kind of ignore it. And then I've also kind of been trying to think about like which one has recovered more since we've reached the bottoms, which depending on where you kind of like time that lining from, for the most part, I mean, BXSL has recovered more, which doesn't really make sense to me because FG actually has much more like equity operational leverage to it. So from that perspective, you would expect that the recovery should be much more significant for FG overall, which makes me believe that it has partially to do with the fact that FG has such a low float and also a smaller market cap flat out than BXSL as well. So again, one more reason why I'm kind of hopeful for earnings. Again, very small, short-term kind of, non-valuation based things here. So, take it for whatever granted you want. Like I said, I'm not necessarily expecting anything super particular from this earnings whatsoever, but I'm kind of hopeful for it. And so that's why I've been like, why not buy some more, especially as it kind of looks like we've kind of somewhat hit a bottom here. I'm hopeful for it. And then also within that context, you can kind of look back even further and say, well, we are also kind of like lined up with sort of a support line back here as well. I'm not really a huge charting person myself, but I know other people are. So it's one of those things where it's like, it's hard not to take that into account perhaps as well. And it looks like maybe other traders are kind of having that same sort of logic. So I'm hoping for earnings. We'll see about it. I was almost tempted to even maybe even go for like a call option into early 2026 or something, but I'm not really a big fan of playing call options. I play with the puts here and there, but not so much on the call side. But anyway, so that's what I've been doing with the portfolio. That's pretty much all I've been doing with the portfolio. In actual action, I have been reevaluating all of my valuations pretty significantly. And that kind of comes with the fact that I've actually been working on a new valuation template, which I've kind of been talking about a little bit behind the scenes. I've actually kind of gone through a couple different iterations of new valuation templates because I wasn't really super satisfied with what I was coming up with. And so I'm always kind of caught between multiple goals that are somewhat contradictory when it comes to trying to make my templates. Like I always want them to be simple, but also complex, and do everything, but also be relatively quick and easy to kind of throw a new valuation into. And it's like, it's very hard to make a valuation template do everything, but also be a template, meaning that you can kind of work with any type of company for it. So it's very tricky. It's one of those things where it's like, I just don't like to start from literal scratch when I'm working on a valuation and having to kind of rewrite all the formulas and stuff like that. It's like, I know how to do all of that, but at the point is it's very easy to sort of accidentally get something wrong with a formula in a spreadsheet if you're doing it over and over again. So it's one of the things where it's like, it's nice to do a template because you can kind of just make sure you've really got it right. And then you got it right. Right. So yeah, whatever. Getting caught between why I'm always kind of doing new things with that. But anyway, I had showed this, which was my new kind of watch list, which is kind of in the same vein where, you guys have seen my previous watch list, and this one is a lot simpler and more rudimentary because, well, frankly, I've kind of given up on trying to make it super clean and neat and sell it to you guys in terms of the watch list itself and the templates itself. I do have, things I wish to hopefully try to market to viewers and subscribers in different ways, but I guess I'm just taking different approaches with that, especially since like those things, because that kind of created other contradictory problems for myself as well, where I wanted my tools to be perfect for my own usage, but also be workable for any other random viewer and subscribers usage, and that itself created a similar kind of contradiction where you need something to sort of be simple but complex at the same time. So just sort of giving up on all that. It's like we're gonna fully separate out the things that I use for my own analysis versus the things that I attempt to maybe market to other people. And it's like, let's not try to mix those two things together because it just doesn't seem to work very well. But anyway, getting off track. Here's the new watch list, which is a work in progress. We're still working on it in a lot of different ways. And then with that was coming a new valuation template and a new allocation system. And then my new allocation system also kind of came along with some new some new strategies, some new models on and stuff, which is kind of some of the other stuff I want to talk about here today. So like I said, this is a work in progress. Don't get too attached to the layout or anything of that. I'm kind of changing things as it goes, but we have allocation targets, expected returns, upside, the DCF values, and you can see there's not a lot of values in here. And don't even look at the actual values here too much, because like I said, I'm kind of reevaluating all of my companies right now anyway. So like there's numbers here, but these aren't necessarily like what I actually think about the companies. They're just enough information thrown into the template that I was satisfied with it and moved on. So yeah, don't pay too close attention to these actual numbers here. Just I'm working on stuff. But let's see, where was I going to go with that next? With that, like I said, there's the new allocation system. And then so kind of coming over here, I have shown, this over here, but I haven't necessarily explained kind of like the dynamics of this over here. Obviously there's these red ones and the blue ones, which are the red ones, you may notice, are all ETFs, which actually these ones should be red. I need to change that, but these are ETFs as well, which kind of fits into my ETF kind of macro momentum strategy, which is some of those other models, like I said, that I've been working on kind of behind the scenes. So obviously anyone who's watched me for the last 2 years, I've kind of been working through these things. There's kind of like multiple things I have been trying to create solutions for in my portfolio. And I know plenty of my viewers are really only my viewers because they like value investing and like that kind of DCF value approach. So I understand a lot of these things we're going to talk about here is not super relevant to a lot of those people's portfolios. I get that, but I also like investing not just because I like to make money, but also because I find it academically and intellectually interesting and stimulating. So, that's why I am interested in these other types of strategies and stuff like that. But also I was trying to create solutions for my portfolio. For example, anyone who's watched me for the last couple of years knows that I used to hold significant levels of cash in my portfolio. And frankly, that did cause significant drag to my portfolio over the last few years as the market has raced upward. And, you could say, oh, well, that's theoretically going to work out eventually when the market crashes and you can buy things up at the bottom. And that's potentially true. But the point is like you have to make up so much for it in the first place before you can really recover fully. And so thing is I have decided that wasn't the smartest way to approach these things. And then I also had then shifted to holding instead of large amounts of cash, instead of holding just significant amounts of S&P 500 ETF allocation, which other people do that as well. And that's fine too, except for the fact that I am pretty supremely distrustful of indexes and ETFs and a lot of the kind of market dynamics around them. And in particular, the concentration within the index and valuation and all sorts of things. There's plenty of kind of left tail black swan kind of scenarios that I definitely find concerning. So it's like, what do you want to hold your cash balance in something like the S&P 500? And so, I've tried various compromises between the two, having kind of mixtures between the two. I've over time have tried to kind of come up with various solutions with that. And then in addition to this, also kind of like on a more private note itself, my portfolio here over the last few years, in terms of like the purpose of it has changed a lot as well. I had primarily and historically had only really been managing money for myself, but I actually do provide portfolio details privately for a much larger amount of money than my own personal portfolio. And so not only did I need these solutions for myself, but I also sort of needed solutions for the other money that I'm technically managing as well on a private, more personal basis. And this not professionally, I work in commercial banking. I'm not an investment manager, but on a private basis, I do provide portfolio allocation advice to other people, just in a private, non-professional form. So anyway, the point is that with that, I couldn't allocate the position sizing I do for my own portfolio, for example, like 20% to FG to the other funds in the same way that the other way. And so I sort of had to kind of create a more complicated dynamic way to allocate my positions. And that required me to think a little bit outside the box. It's like, did I want to dilute my ideas down and have several more kind of more poor, in my opinion, investment ideas that I'm still allocating significant amounts to? And what I've opted towards instead is larger amounts towards ETFs. But what I've created instead is a momentum-based strategy to handle my ETF investment, or liquidity management, could I guess be a better way of speaking of it. Because my purpose here is still to try to feed the majority of my portfolio towards individual stocks. As you can see here, it's still 72% in individual stocks, and that's the most of it. So we still have 27, 28% ETFs, and this could become a larger amount towards ETFs over time, but we still want to have a majority of individual investments. But the point is, I want to be able to kind of take my time, not try to swing at every pitch, and look for the most superior investments instead of just somewhat barely market beating investments, but look for like truly market devastating investments, if you can. I don't know, I'm kind of rambling here in a large way, but the point is that I've created, a momentum strategy for my ETFs. And then also another factor that this created a solution for is that anyone who's been watching my portfolio for the last couple years will know that I've also been allocating significant amounts of my portfolio to gold, but not just gold miners, which are kind of traditional cash flow valuation investments, but also to a gold ETF. And that was fine for the first couple years of it, when I was much more adamant and certain that the gold commodity price was underpriced relative to where it ought to be for various market dynamic reasons. And that's turned out to be very true. Obviously, look at gold. It has in fact doubled since 2000. And I was already kind of calling myself successful in that call when it was at 2000, because technically I had really started investing in it when it was at more like 1200 to 1300. So we had long since surpassed essentially the kind of minimum expectations I had for gold, but I didn't really have a very clear approach to how I was going to think about where I really thought it could top out. Like what was the plan? What was the real exit strategy for gold? And so I had to kind of come up with a strategy for that too. And so this momentum strategy essentially was a solution for that as well, because I've approached it on like a purely momentum basis, where, well, really it involves volatility and momentum. But the point is it has to do with volatility and momentum, which is independent of whether it's a stock or a commodity or anything like that. So anyway, coming over here, I'll actually show you kind of what I'm talking about. What I've been kind of rambling here about is that I have created a pretty neat strategy, in my opinion, that basically combines macro theory with momentum strategies, and then also a lot of elements of volatility adjustment into that momentum to essentially kind of take a look at which markets amongst major asset classes are outperforming on a momentum basis, and shift the allocation a larger amount into those assets over time. And the reason why this would work, theoretically speaking, is that as long as one of these assets is maintaining a decent amount of momentum, and that means as momentum deteriorates, which is what happens when you are going into corrections or bear markets or crashes or whatever, then that is a natural effect that happens, is that one asset falls out of its momentum first, and then other assets fall out of its momentum second and third, and so on. And so the point is that if you can at least kind of like measure that on kind of like a decent basis, then it doesn't matter if you're not going to time the top, but you don't really need the time the top as long as you're shifting around the allocations appropriately. So along the way, I created a kind of a somewhat a simple allocation, but a complex strategy. It's like a complex strategy for actually doing the allocation, but it's simple enough in terms of its kind of base allocation between the S&P 500, the Russell 2000, the international index, which I'm using VEU as kind of my proxy for, and then gold as well. And I've created kind of like a base mixture for those allocations of 40% the S&P 500, 20% the Russell 2000, 10% international, and 30% gold. But really, you can kind of shift those allocations around. In fact, like even within this spreadsheet, I've made it so that I can relatively simply shift that allocation around and show you kind of how that changes the results of it. So I'll do that at some point here. I chose those percentages for kind of subjective reasons. Those subjective reasons have to do with my own perspective on the kind of macroeconomic potentials for those assets on a kind of like a probability adjusted basis, again, subjectively, over the next decade or so. So it's like, what do I think about those assets? Like I said, and so that's kind of where that mixture came from: 40% S&P 500, 30% gold, 20% Russell, 10% foreign stocks. But you could, like I said, you could shift that around and do whatever you want. You could look at it with 25, 25, 25, 25 if you wanted to, which I have multiple times. So I'll show you that here. Anyway, the point is like here it shows those 4 assets. The blue line is the raw performance of that asset. And you can see it goes back to, what is this, early 2008 is where I have the records of this going back to. And this is weekly data for the record. This is a weekly based strategy. It works on a daily basis, but the thing about trying to create creating model strategies and backtesting them is that if you do it on daily data, oftentimes the backtest will look really good, but good luck actually trying to trade it on a daily basis, because you're going to end up having significant tracking error in your buying and selling. So that's like the thing that I've found over my experimentation over the last couple of years with this type of kind of like rudimentary quantitative modeling, is that, you know, you can make things look very nicely on a daily chart basis, but good luck actually trading that. So I opt for weekly data points, because it's still fine enough that you get significant shifts in movement, but then you really only have to make one trade per week, so to speak, or, you know, it's multiple trades, but one shift in allocation per week, which really limits the potential for tracking error. But yeah, so anyway, the blue line for each of these is kind of the raw asset, and then the red line is kind of the adjusted performance of that with the trading strategy in place. But understand that it isn't just shifting from this asset to cash, it's shifting from this asset to one of the other 3 assets within that. So that's kind of what I mean by it. Instead of like it just saying momentum where, oh, this asset's losing momentum, we go to cash. It says, no. We, for each of these assets, have essentially like a backup list of assets where it says, okay, well, if the momentum's bad in the S&P 500, let's opt for gold. And if momentum's bad in gold, well, let's opt for this. And yeah, and then Russell has his own thing where it says, if Russell's momentum's bad, let's opt for the S&P 500. And if the S&P 500's momentum's bad, let's opt for this. And like I said, all 4 of them have their own kind of prioritization list of where they will opt to shift the momentum to. And that's what you see with the red line, is the performance of it, including shifting to that other asset. So that's why you can look here, for example, I'll show you kind of what I mean, where it's like, here's gold, here's the kind of clearest one, where it's like gold, it looks like gold, and then suddenly gold has a really bad time, and then the red line doesn't have a really bad time. But what it's doing here is it's trying to shift into gold as much as possible, but gold's not performing well enough for it to really do so. So in the meantime, whenever it says, no, we can't go into gold, it's probably mostly shifting to the S&P 500, I think. And like I said, it's failing to really capture a lot of the upside of the S&P 500. As you can see, it's really kind of mostly flat during this period, but it's not declining like gold. And that's because, like I said, it still has a bias towards gold. It wants to do its default allocation, but it will shift towards those alternative allocations if the momentum says it's not good for that week, right? And then the yellow line here, or I'll say the green line first. The green line here shows what that allocation is within the total strategy when you combine all 4 together. So like each of these, like I said, have a default allocation. The S&P 500 is defaulted at 40%. You can look at the line here. Sometimes it's down to 0%. Sometimes it's down to 20%. Sometimes it goes up to 70, 80, 90%. Sometimes it's 50%. You can see it shifts around over time. But that's the total combined allocation at each of those moments in time. And you can see that for each of these. And you can see, for example, the Russell is actually doesn't ever really shift in higher than 20%. So actually Russell, for the most part, is never really chosen as a secondary location. That is what it looks like. That's kind of interesting. International sometimes is, but not very much. Whereas S&P 500 is chosen as like a secondary allocation spot very, very often. And gold very, very often can be chosen as a secondary allocation spot. There are moments in time where you're 100% gold. Earlier this year, during the tariff tantrum, this strategy was already at like 60, 70% gold. And then it shifted to 80, 90% gold as the market was declining. And then it shifted back towards 30% in like mid-May or so, something like that. So it just goes to show it's like it is pretty effective. And getting to that point, here's the chart that kind of shows the total strategy altogether. Likewise, as I kind of said up here, the blue line is the S&P 500, is just the S&P 500 as is, and then the red line is the passive portfolio, which is just the raw mixture: 40% S&P 500, 30% gold, 20% Russell, 10% foreign, with no trading. If you just said, give me that allocation of those assets over time, that's what the red line is here. So you can see that like that mixture of assets is already a pretty good mix. Like it basically matches the S&P 500 over this 17-year period, which is pretty good. You can see there's periods of overperformance and periods of underperformance, but that's pretty good. That's pretty good. And I think the weighted dividend yield would be modestly lower, not like super lower, but it might be a little bit lower within that portfolio too. So because that technically doesn't include that too. So total returns might be a little bit lower as well on a relative basis, but it wouldn't be extremely so. But anyway, and then outside of that though, the yellow line is if you include the momentum strategy as well in there. That's the active portfolio here. So you can see it outperforms pretty significantly. And yeah, a significant significant portion of that outperformance came from 2008, 2009. It's worth noting that you always kind of want to take in the caveats of certain like historical extreme moments into account whenever you're looking at these types of backtests. But what I will say is that it decayed a lot of that overperformance over this period right here, like 2013 through 2016, 17. It really decayed a lot of that. In fact, you can see that here because that's what some of these other lines are. Is that the blue line is the overperformance of the yellow line against the S&P 500, and you can see like that overperformance peaked in 2011, and it actually has never come back up to that peak level of overperformance again. As like I said, that overperformance decayed, but a lot of it was because of 2008, 2009 was such an extreme event. So frankly, a lot of this big bump up was probably fluffed, essentially, is kind of what I would say there. And you can see, like I said, it decayed over time. 2018 it looks like it had a pretty strong relative bottom, and then it recovered pretty significantly up through 2022. And then there was a little bit of a decay down to 2024 again, and then it's recovered a decent percentage amount through where it is in 2025. But still of about 60% of overperformance over a 17-year period, which doesn't sound like a crazy amount, but for this type of strategy with this kind of like just these 4 ETFs of broad markets, that actually is pretty impressive. And then the red line here is the overperformance of the yellow line against the red line. So again, it's the active portfolio against the passive portfolio, which is basically just means it shows the overperformance of just this trading strategy itself. Like what is the alpha of the trading versus the alpha of just the asset mix, right? And so that's why I say here, it's like, yeah, you can see that, yes, the cumulative alpha against the S&P has this like peak way up here in 2011, and it looks like it decays ever since then. But you can see that the red line, however, has a much more steady stair-step process upward. It's flat for long periods of time, and then it bumps up, and it flat, bumps up, flat, bumps up. And a lot of those bump up periods, you'll notice, is also when the market has turbulence. Big volatile moments is where that bump up comes, and it's almost at its peak point. Like I think its peak point is technically in 2022, so we're not quite at the peak point, but we're pretty close to it. And you can see that the blue line and the red line, the deep blue and red blue, the different alphas, they actually converge over time. So that's the other thing too, is that I think over time that will continue to be true, is that really like I said, this big bump up here is because of 2008, 2009. And then the other thing I kind of want to show here is that the other yellow and blue line here shows the drawdowns, which is one of the other things that's super beneficial about this strategy. Because again, I built this because I was trying to create solutions. I wanted a solution where I could park my excess liquidity in the S&P 500 essentially to a large extent, while not feeling like I'm essentially putting that liquidity at risk because of like an AI bubble that expands and then eventually pops, right? Like you want to participate in the expansion, and then but then you also don't want to, get the full downside of the pop of a whole bunch of companies that I didn't do like strong valuations on, right? And so that's one of the reasons, like I said, I created this strategy. And then likewise, I sort of had the same need for gold, is that I wanted to continue to be long gold for a variety of reasons, but I wanted to now start to protect myself from the downside of gold now that I've captured a significant portion of what I saw as, you could say, the easy money in the gold story. And so this solution created that solution for me as well. And then, like I said, the other thing I wanted it to do was to also create essentially a protection system for the other money that I'm privately trying to allocate for outside of my own money, which I'm willing to take a much larger downside risk on. And so that's where, like, this next detail I'm going to talk about is the drawdown difference. The drawdown difference is significant across the majority of these correction periods you can see here. So looking at 2008, 2009, you can see that the max drawdown that the S&P 500 got to was like 56%, 56, 57% or something like that. Whereas the max drawdown that this strategy got down to was like 29 to 30%. So almost half the drawdown during the financial crisis this strategy manages to have. And then it recovers to all-time highs by mid 2009, whereas the S&P 500 did not recover to all-time highs until 2013. So that's why it had that crazy outperformance spike. But that's pretty wild. The strategy was going through its own new drawdowns again by the time that the S&P 500 reached all new highs again. But then moving on here, you can see in 2015 there was a little bit of a correction here. They were close to about even here. I think that the model strategy really only beat the S&P 500 by like 2 percentage points or so on the downside here, but it did recover mildly quicker as well. Coming on to 2018, the downside was like 10%, where the S&P 500 it was like 17 to 18%. So about 2/3 of the downside during that one. Also a faster recovery. 2022, or well, let's not skip along here. Or my bad, I skipping past 2020. How can I skip past 2020? 2020, the S&P 500 drawdown was like 32%. Whereas the drawdown of this strategy was like 13%, 14% or something like that. So again, about half the drawdown for that particular one as well. And that's the 2020, which was really fast too. So keep that in mind too, is that it managed to pull that off with such the sharp correction on that as well. Again, a weekly strategy. So whatever happens within the week, it's not going to be able to pick up. But the question is how quickly can it pick it up on those weekly signals, because it's using like the last 15 to 20 weeks worth of information for the most part. Like basically at any point here, that's basically all it's really looking at is like the most recent 15 to 20 weeks or so, I think it is, depending on the part of the signal it's looking at. So that's the thing, is like it's very much looking at just kind of recent momentum and volatility information across these different assets to say, okay, well, what do we do? And that's what it does. And then looking here, going on further to 2022, it did not do amazing in 2022. It looks like the S&P 500, it had a max drawdown around 25%, 24, 25%. And then this strategy, it was like 21, 22%. So only like 1 or 2 percentage points in 2022, unfortunately. So that's less impressive. However, it still managed to get back long pretty good and participate for the big bull run of 23 and 24. So that's where I would say is pretty good, is that it at least managed to dampen the volatility significantly, because it also didn't, you can see, reach up to that 2021 peak. I don't have a chart to show the peak parts, I just have the drawdowns. But you can see it didn't get up to that 2021 peak, but then and then bottomed a little bit lower in a nominal sense. But keep in mind, it didn't peak as far, so that's where it was a lower drawdown and then participated further. And this is the raw portfolio part. This isn't the managed part. Keep in mind, I'm just showing it here because you can see it compared to the blue line much cleaner, but like, here obviously did better. And like, look at how it's performed in 2025, especially this second half of 2025, where it's had large gold allocation. Because for the record, it is over allocated to gold right now. We're at, I think it's 50% allocation to gold right now currently. And also for the record, one of the crazy things is that it actually timed the pullback in gold that we had recently here almost perfectly. And I'll be honest, and that part was probably somewhat lucky what it did here, because it had me go extra long, like I said, because my default allocation for gold would be 30, and it shifted from 30 to it shifted 20% of the S&P 500 allocation to the two golds. So from 40 to 20 for the S&P 500, and from 30 to 50 for gold, and it did that here on this. I think it was the 8th. It basically had me on this Monday, which I'm pretty sure I missed about 1% on the tracking error of Monday there. And it had me shift that allocation here. And then literally on the Monday of this week right here, it was Tuesday where the drop was. On this Monday, it had me shift the allocation back to 30%. So I didn't under allocate to gold for the decline here, but I managed to capture the the overperformance from shifting of the allocation, which was really cool to see. Really cool to see. Like I said, probably a little bit on the lucky side in some ways for that particular detail, but nonetheless, I was watching it and I was like, that was really cool. But yeah, and then like I said, it shifted me back to 50. So that's the other thing too, is that it did that, and then literally by the end of that week, it said, okay, go back to extra long again in that week, which was here. It was this signal, so it was this day here, which the most of this decline was in the morning. So really, I missed about half that decline as well. Because like that's the thing, is that's what I mean by tracking error, is that the signal is as of the information for Friday, and then I put the order in on after Friday, so I put it in on like Saturday for the sells, and then Monday morning I have to open up when the market opens and then do the buys. So there's a little bit of a gap there between the sells and the buys at the market open, and that's what I mean by tracking error. So basically, whatever happens in that first few minutes of the pre-market into few minutes of the market on a Monday when it shifts the signal, there could be a little bit of a miss there. But again, the point of this is not to make big gains in 1 week. The point is to be long the asset when it goes on a multi-month period where it's just blasting off. That's the point of the strategy. And like I said, it works on kind of multiple fronts, where it is taking it's trying to take the momentum on the upside of the assets into account, but it's also taking the downside of other assets into account at the same time. So that's why it manages to do that. So again, that's why it managed to avoid being allocated significantly to the S&P 500 during the tariff tantrum earlier this year, and that's why it managed to be long during the kind of extra push that gold has done here in these last few months as well. So we'll see how it performs going forward. I will say, coming back to this, looking at the historical data over this entire period of time, what this ends up being is about almost 3% of annualized outsized return against the S&P 500 is what this outperformance actually ends up being. So maybe you cut that in half, if you want to like be, or that's how I'm kind of thinking about it. Is like it shows in the data 3%. So maybe going forward, I will assume that this strategy might give me 1.5% of alpha against the S&P 500. And then also I did kind of created a somewhat similar system for sector ETFs within the S&P 500, which works pretty well, but it's less effective, which only creates about 1% of outperformance per year, or it's actually a little bit less than 1%. So you cut that in half, and that's maybe 0.5%, and that's additive to this other strategy, for the record. So it's not like you have to average them together. It's like, no, that 1% of alpha that the sector ETF strategy does would stack technically on top of this alpha too. So the historical performance shows almost 4% essentially. And so I'm saying you cut that in half to be conservative, and that gives you maybe 2% of overperformance. So if you think the S&P 500 is going to do 10% a year, then this gives me the ability to say, okay, well, actually, I don't want to use that as my opportunity cost. I want to instead think of 12% as my opportunity cost, which, I already always wanted a margin above that for my investments, right? So like if I think the S&P 500 is going to do 10% a year, well, then I want to invest in things that are going to give me a solid 12% a year, or maybe a more riskier 15% a year, or even maybe a higher risk 20% a year. That's kind of how I would generally think about these things. But if instead my default strategy, I feel like, can confidently give me 12% a year, then you see we can scale that up further, where instead, let's say, well, okay, well then let's look for more like a safer 14 to 15%, and then maybe a riskier 20%. And a higher risk 25%. So you see, like that's kind of one of the values, I think, of this, of how that can play back around to the valuation part of the portfolio, is that it allows me to really just trust the ETFs, because and I know plenty of people watching this might say, well, I don't trust your strategy. Well, that's fine, but you don't have to do it. I'm the one that has to do it. Like I said, I created the strategy to create a solution for myself. And like I said, that solution was multifaceted. Concerns about holding too much of the S&P 500, but also wanting to participate in the upside of the S&P 500. Concerns about the fact that gold is a commodity and it doesn't really have a valuation basis. So I had to kind of create like an exit strategy for myself for that. And this will work. It will work. That by definition, if gold goes through another period like from 2011 through 2015, 2016, which I think is possible eventually. I don't know if it happens now at 4,000 an ounce, but it will probably eventually happen, whether it happens here or 3 times higher than here, you know? But the point is, I need some sort of just system to get me out of it. And this will for sure work for that. You know, it won't catch the top perfectly, but it will certainly miss most of the decline for gold. Though it will by default also try to get me back into gold. So that's the other thing about it, is that it does by default assume that you want to be in gold. So if there ever comes a time where I actually want to be completely out of the as a default, well, then I would need to kind of do something else with this. And a lot of this part of the strategy does rely on gold. So I would probably have to rethink that altogether. But the truth is I'm not sure that that's really something that'll happen anytime soon. Yes, I'm worried about eventual potential multi-year periods where there will be a bear market in gold, but that doesn't mean that I am like going to be perpetually bearish on gold. I just believe that there will eventually come a time like 2011 through 2016, you know, it will eventually start to take off again, in my opinion, unless we exit the monetary system that the entire world works on. So, which doesn't seem likely to be true. So anyway, coming back over to here to take a look at the mix. Like I said, these should be red, so it kind of cuts it off. As I said before, the strategy is currently overweighting to gold. So we do have a significant weighting to gold here of 13%, which might seem extraordinarily high, but like I said, it shifts back and forth between like 5 to 6% and 13%, depending on what's going on a little bit in some ways. And there's almost no S&P 500 here, as you can see, but that's because it's taking into account the S&P 500 sector weightings that I have here as well. Because like I said, there is kind of a sector weighting piece that I have built into this as well that allows me to participate in specific industries that might be going through multi-month or multi-year bull markets, which you'll see the ones I have here are communications and tech, which might make perfectly sense. You know, if you understand what's going on in markets and momentum in the last couple of years, it makes perfect sense. Which, by the way, for the record, it shows communications here, but I actually already put the sell in order in for that because it is telling me to get out of that next week. So, but who knows? Maybe in a week or two after that, it'll tell me to get back into communication. I don't know. The point is, like I said, this is just a way for me to manage my excess liquidity. My excess liquidity is about 27 to 28%. And this is what I'm doing for that. And then, like I said, this also allows me to allocate larger amounts to that larger amount of money that I'm privately helping manage. That creates it so that I can essentially fit all the roles I need to fit at the same time, while still having my main portfolio kind of be the main thing there. So yeah, long little bit there. We kind of went on for that a little bit of way there. It was a very complicated piece, but I had been kind of waiting to talk about this for a long time because I did technically implement this some time ago. I've been kind of doing this for much of the year. It's kind of come out in stages, like the kind of core 4 asset part of it got implemented in like over the course of March and April. Like I said, the strategy performed really well during the tariff tantrum, but I didn't actually implement it until basically like after the tariff tantrum had already occurred. I was working on it prior to that, but I didn't actually get it done and fully implemented until then. So I didn't get to fully take advantage of that lack of the drawdown as I was talking about, unfortunately. But I have taken advantage, like I said, of the over allocation of gold that it's had over the period since then. So you know, mix is what it is. We'll see how it keeps going forward from that. But I would say it's like basically since May is really when I really like fully kind of implemented that 4 asset part into the strategy. And then the sector allocation part of it took a few more months until that really kind of started being implemented in. And then as you see here, I didn't mention this one. This is small cap tech, for the record. That's what this ETF right here is small cap tech. But yeah, so we'll see how that performs over the coming time. I need to actually kind of come up with a way to measure the performance of this part of the portfolio, because like I can look at the performance on the model over here, but like I said, that doesn't take into account my tracking error. So I kind of need to try to come up with a way to measure it in the realized portfolio. Like I have my portfolio returns that I measure, but I need to try to like separate out and try to measure the returns of just this part of the portfolio. I haven't done that yet, but I would like to do so because I would like to see how the actual performance compares to essentially the model indexed performance, so to speak. Because there is some tracking error. There is some tracking error. You're probably going to lose like 1% here, 1% there. And then, as I mentioned with the gold thing, technically you can sometimes gain a percentage from tracking error as well. But my assumption, my bias is to assume that I'm going to lose more than I gain. Technically, you don't really know that for sure, but it can go either way. So, but my bias is to assume that you're probably going to lose rather than gain. But the question is how much? And like I said, using a weekly data set, you limit the amount of your exposure to that issue. Technically, if you went to monthly or quarterly or even yearly data, technically you would even limit the amount of tracking error even further. And this is basically the same logic of them saying, like, in terms of investing, that the more times you handle the soap, the less soap you have, right? So that's it's like the same logic, basically. So yeah, that's one of the big things I've been working on over this year. Like I said, that I've kind of been hinting at over the last few streams or so, that I hadn't quite gotten around to talking about because it was a lot to talk about. But I have been working on what I think are really cool stuff. I know it's not, like I said, it's not valuation stuff. So I know a lot of my audience might be like, well, cool, but that's not useful for me, which is fine. Like I said, I didn't build it for you guys, but I mean, if people are interested in it, they can talk to me about it. I think very cool. And it'll be even cooler if it actually works over time. So we'll see how that goes. But there are other things I've been working on too. Various economic models and things like that, and just kind of like other signals and models and stuff. One cool tool I wanted to also talk about is this sentiment and positioning kind of gauge that I've been trying to put together. And this is very heavily inspired by some other people's work that I've seen around there, around the internet. So, I didn't fully come up with this myself, but I did put it all together. I did have to kind of put it all together myself. So there is that. So here it is. I'll kind of go through it all. It's a little bit complicated. But basically, what I did is put together an automatically refreshing weekly data set of a variety of different signals here. You can see here it's showing NA here, but just give it some time. It has to communicate with other spreadsheets, and sometimes it takes a minute for things to move around and refresh. Oop, there it is. See, it took a few seconds and suddenly it auto updated. But anyway, you can see here up here at the top is kind of like the different signals that kind of go into it. And I actually have plans to expand it. There are a couple other extra signals I want to add into this eventually over time. So it will become even more comprehensive, I guess you could say, over time. But nonetheless, it's already basically at a pretty effective level. So here we have the bullish and bearish percentages from the AAII surveys, which a lot of people talk about as the bull bear spread. So we here have the bullish percentage, the bearish percentage, and the actual bull bear spread. Now here I'm in the lines below that, I'm showing what the long-term average of any of these values is. And then I'm showing below that what the current value is. And that value is as of the end of the week. So it automatically records and refreshes the data point for all of these indicators as of the end of the week. So literally as of Friday, yesterday. So because some of these are weekly information, some of them are daily information, but no matter what type of signal it is, it's just looking at that Friday signal to just give you the context of it. And then what I did for all this is that I looked back, like I said, we're looking at the long-term average here, but then I also looked through that entire history and then took a percentile of that data here too. So for example, here you can see that the long-term average for the bullish percentage is 37.6%. We're currently at 44%. So that means we're above average. But you might say, okay, well, how above average is that? Well, it's at the 74th percentile. I've talked about percentiles with my valuations plenty of times on this channel, so hopefully you guys kind of understand that. 74th percentile. Likewise, we can over here look at this and say, okay, well, the bearish percentage is 31%, and the current value is 37%, which is also above average. But how does that compare? It's at the 74th percentile. Now you'll notice this one's red and this one's not, and that's one's, I think, probably because of decimals here, or that are okay. Well, maybe not. They're actually, what's going on there? Maybe I need to. Oh, never mind. I'm confused myself. The reason why this one is not red is because technically, if it needs to be low for it to be red, this one's a reverse indicator because bearishness is the opposite of bullish. kind of confused myself there for a second. So if it's above a certain range of the percentile, it is going to show red here. But you can see for some of them it's low. So like likewise here, you can see stock percentage high gives you a red signal, but then a cash percentage low gives you a red signal. So you can see it kind of reversed on that. And then likewise, if it goes the opposite direction enough, then it will in fact be green, showing that that's not really a negative signal at all. So anyway, now that you see how to kind of read the information here, as I said, we have the bullish percentage, the bearish percentage, the difference between the two, that percentage, which is currently actually a little bit above average as well, but only barely so. Then the same survey group, the AAII survey group, also asks for allocation information from individual investors. So they give a stock percentage self-reported allocation number, and this is the combined individual stocks and ETF and fund stocks percentage. And then they also report bonds, funds, and individual bonds, and then they also report cash. I didn't include the bond information, I just included stocks and cash, but here you can see stocks. Stocks are way over allocated compared to history, and cash is much lower compared to history. NAAIM stock percentage, which is kind of a similar thing, a self-reported stock percentage thing. Now, this is specifically a US stock exposure percentage, and it's an exposure percentage because this is actually money managers. So this is like institutional money managers, which means that they can actually report leveraged positions as well as short positions. And so it's like a total exposure number. So here you can see the current value is actually above 100%. So that indicates that there is technically slightly more slight leverage in the system. Long-term average here you can see being about 67%. So we are high on that stock exposure, U.S. stock exposure, self-reported, like I said, of institutional money managers. And then here we have the S&P 500 non-commercial net long. So this is kind of similar to this, where this is a kind of a professional money manager metric, but this is a self-reported metric, whereas this is an actual reported metric. The CFTC has reported positioning metrics for a variety of assets, and I've included the non-commercial net long positioning, which is basically a speculative investment positioning for S&P 500, and I also have it for gold as well here. So you can see for that gold, for that S&P 500 is actually low. It's actually low. Now, one thing I will point out for both of these is that both of these two metrics have actually been affected by the government shutdown. So these two metrics have not reported for the last like month and a half, unfortunately. So these ones are a bit of a delay on that. But to be honest, this one was there for a little while. So like it might have changed a little bit, but I don't suspect that this has necessarily changed that much. Like maybe it went up to like 20-30% or something. I don't know. We'll see whenever the shutdown ends. And then this one might have come down a little bit, but it probably hasn't come down that much. So it probably hasn't shifted the overall situation here too much, is my point. But nonetheless, these ones are on an abnormal delay right now, is basically my point. Then here I have the 3-month implied correlations number. Now this is comes from a lot like similar metrics and way of kind of thinking about things as the VIX, but it's instead of measuring volatility, implied volatility based off of option prices, this measures implied stock correlations based off of option prices. And specifically, it's measuring the correlations of the S&P 50, so the top 50 stocks. It's not really doing it across the whole index, so it's because there has to be a very liquid amount of options in order to do this calculation. And the reason why this is valuable, I think because this is actually, in my opinion, probably one of the most valuable signals on this data set. Because what this does is this tells you how people are positioning based off of what they expect the risk is in the stocks, right? Because people invest in different stocks because they believe that they're going to get an uncorrelated positive return against the S&P 500. That's what we call alpha. And so, but whenever people are positioned in a way that it implies low correlations, that basically means people are taking on large amounts of risk and they perceive it as low amounts of risk. Or I should say they're just taking on large amounts of exposure. Maybe it's not risky, but the point is that they are perceiving very low amounts of risk. And that's the point. It's actually, out of like all these signals, like it's probably one of the most effective ones here. So that's why I'm like really wanting to explain that one, because I know like that's not a very talked about signal, the implied correlations index. People talk about the implied volatility index, but people don't talk about implied correlations index. People talk about rolling trailing correlations from time to time, but implied correlations, not too much. But then here also I have breadth indicators, the percentage of the S&P 500 above the 50, their 50 SMA, and the percentage of the S&P 500 above their 200 SMA. Likewise, this gives you a sense of like where people are positioned. Like are they really all in on the S&P 500 and basically all super long? And that's fine when things are going well, but then it's fine not good when they aren't. Then we also have the S&P 500 forward PE ratio. And you'll notice that's the only thing on here that's a valuation metric, or I should say it's the only thing on here that's a stock valuation metric, because technically the VIX is a valuation metric like a PE ratio. It's just for options. So, but in a sense, it sort of is like a pricing value metric of a sort. It's just not for stocks. But anyway, S&P 500 forward PE ratio should be no surprise to anybody that it is at the 84th percentile of the data set. So not great. VIX also likewise, you can see here, that's one that's on here, but nothing super valuable there. And then the VIX 3M spread. Now this is one that I personally have grown very fond of over the last few months. I think it's a very valuable signal, especially in combination with the VIX. Like you combine these two together and they actually give you a lot of information about volatility. The VIX spread, like the yield curve on treasuries, tells you the difference between different values of the VIX at different parts of the duration curve. So like with the treasury curve, you take like a difference between say like a 10-year treasury and the 2-year treasury, and the difference is the yield curve, and it kind of gives you the idea of like what extra premium is being priced into the bond yield for the risk of a 10-year versus a 2-year. And so the VIX does the same thing. Most people, when they talk about the VIX, and when people say the VIX, this column right here, the VIX, is actually the 1 month implied volatility for the S&P 500. But you can look at the 2 month implied volatility. You can look at the 3 month implied volatility. You can look at the 9-day implied volatility. You can look at the 1 year implied volatility. There's a whole curve there of forward expected volatilities. And so here, what I'm looking at is the difference between the 3 month and the 1 month VIX. And that gives you like a little spread there, which is the premium that is being priced into options for the expected potential changes in volatility. And like I said, I think it's actually a very valuable signal, and it is up here at its higher end of the range. So anyway, as you can see here, I'm looking at the percentiles of all these different metrics, like I said, and the percentiles is across time. And then we're looking at like, okay, well, what is the median of all of these percentiles across all these? And then all the ones where a low number is technically a negative thing versus a high number is actually a positive thing. I have 1 minus the percentile as kind of my proxy for reversing that. But so yeah, that gives you kind of a median metric, so to speak, across these different percentiles. And the median metric right now is 75%, which I have it set to say as between 50 and 75%. It says is high. If it goes above 75%, it sets it to very high, I'm pretty sure. So this is, yeah, technically below 75%, you can see, but that is what it is. Now, then you say, okay, well, what's these tables down here? We haven't talked about any of that. What's going on here? So what I have here, because like, what's the point of this? You might say like, okay, cool. What's the point of this? Like, what does this tell you? Like I said, this is sentiment and positioning. All these indicators tell you how the mood of various investors are, and also like what is their actual positions. Like this is information that tells you like where the money currently is sitting and what do the people that are in control of that money think. That's basically what all this information is. It's mood and momentum. Well, not momentum, mood and positioning. Sentiment, it's my sentiment thing, but technically it's a lot of sentiment and positioning. So what I did here is I looked at each of these signals and I said, okay, well, let's go back through history and look at all of the market corrections, big corrections. And specifically, I used 20% and up. And so I looked at through all this data set, which really like the earliest point in these data sets begins in the second half of 1987. So really we're looking at from August 1987 onward, look at all the 20% corrections and higher. And that's what we have here. We have, how many is it? 10, 20% corrections and higher since 1987, which in a way almost sounds lower than I would have expected. I don't know, but whatever, that's the market history. That is what it is. So, which isn't a huge sample size. I'll admit 10 is not a huge sample size, but nonetheless, it is what we have for this particular data. And like I said, I hope to maybe expand the data set to a few other signals here, which might make it so that maybe I'll be willing to go back further in the history, because obviously not all these signals goes back all through history. And some of them I haven't put all the data in here. Like for the implied correlations, it only shows 2 signals here. Technically, I know that I can take it back to like 2007. I just have to fully acquire the data for that. But anyway, the point is here, what I'm doing is I'm looking at the market tops. Here you can see these are the market tops, and here are the market bottoms. Again, we're using weekly data, so we're looking at basically the weekly data points of where those tops and bottoms are on a relative basis before it went into these 20% corrections. And then we look to see, okay, what was the signal for each of these at the top, and what was the signal for each of these at the bottom. So it gives you an idea of like what was the mood, and what were people positioned at before all these big corrections, and what were they positioned at after all these corrections. And you know, some of them are different than others. Like they all have very big differences to it. Like, well, let's talk about, for example, like just point out one that I know everyone's very familiar with, like the S&P forward PE ratio. So in general here, and then down here I have the 75th percentile, the median, and the 25th percentile for each of these, the tops and the bottoms. So you can kind of get an idea of what the range is usually like, right? So you can see that like people are usually pretty bullish. You know, sometimes they're not amazingly bullish, but they're always on a relative basis somewhat bullish. But on the extreme end, they can be very bullish. Bearishness, people actually are not necessarily not bearish. You can see like the bearishness is not necessarily skewed to the underside. It's really the bullish part that seems to be driving that. And then because of that, the bull bear ratio does drive to the upper side, generally speaking, when you're at tops. People tend to be highly allocated to stocks at tops. People tend to be lowly allocated to cash at bottoms. Money managers tend to be highly allocated to stocks at tops. The positioning tends to be highly allocated to stocks at tops. The speculative positioning, the gold speculative positioning tends to be highly allocated at tops. And that's the interesting thing, is this is tops in the S&P 500, but yet for some reason the positioning in gold still plays a relevant signal here. So very interesting. And then, like I said before, the correlations is a reverse signal. So you can see the correlations are priced to be low at tops. Most stocks are above their S&P 500 50 moving average when they're at tops, which of course they are. That's just mathematically true. And same thing for the 200 moving average, just mathematically true. Forward P ratio tends to be high at tops. So anyway, you get my point here, is that you can see that it's not true for every signal though, because for the S&P 500 forward PE ratio, you can see that in general, yeah, 91st percentile, 94th percentile, 97th percentile, 76th percentile, 36th percentile, 83rd percentile, 97th percentile, 67th percentile, 24th percentile. So you can see that it's not, valuation, for example, doesn't necessarily drive a big decline. Sometimes people are just positioned really, really high, right? So like the market was not highly priced in 1990, but for some reason we still had a 20% correction. And the market was not highly priced in 2011, but for some reason we still had a market correction. So you can see like it kind of shifts around. And that's why it matters, is that like just valuation alone is not a timing signal. And also it's worth noting that this information here is not really a very good timing signal either. All this does is really kind of show you the sensitivity, I think, to high declines. That's what this shows you. Like, this isn't going to tell you, like, you can't look at this signal and say, oh, it's high right now. That means we're at a risk of a crash tomorrow. No. I can't tell you that a crash is going to come tomorrow. But what it does tell you is that if a crash did start tomorrow, then there's higher risk that it's going to be a bigger crash. You know, that's really what this creates. This is a tool that gives you a sense of how potentially at risk we are to larger declines because of the fact that people are so skewed to one side in the sentiment and the positioning. The lower this percentile is right here, the lower the drawdown, I think, is likely to be. That's really, I think, what this kind of table creates for you. So anyway, like I said, like that was looking at the tops here. You can see it basically looks at the same information at the bottom, and it is largely still consistent, where if it was a high number here, it's probably a low number here, or if it was a low number here, it's probably a high number here. And then it's probably true across most of the instances, but it's probably not true for every single one of the instances. But nonetheless, on a kind of a general basis here, looking at the kind of median value across the different groups here, you can see that the value on a median basis tends to be at least above the 67 percentile. but it could be as high as the 80th percentile. But for at least 75% of the outcomes, it is going to be above 53%. That's basically what it shows here. And then likewise down here, you can see that in general, it's pretty low. In fact, I'd say like it tends to bottom out at a lower level than in a more consistent basis, then it tops out at a high level, you know, because like 53%, we're saying that 75% of the outcomes occur whenever it's above 53%. Well, that's pretty good, but 75% of the bottoms occur when this metric is at 19% and below, right? So you can see it's like it actually is better at confirming bottoms than it is at confirming tops, which is itself kind of a very neat, I think, detail. So here I'm showing that. Here is the difference. You can see like the actual difference in the metric for each of the metrics. And you can see some of them are larger than others, but in general, there's a very significant decline in the overall metric over the course of whatever time frame the period was of the decline, which I don't think I measured that actually. Now that I'm thinking about it, I can do that real quick. I thought I did actually, didn't I? I could have sworn I did actually, but hold on, I can very quickly calculate that. Here's all of them in days. Let's put them actually in weeks, since I'm using weekly data. Let's take a look at the average and the median. Okay, yeah, so pretty wide range for these 20% declining corrections. We have a pretty wide range. One of them as short as 5 weeks or so, and another one as long as 133 weeks. On average, they're 32, 33 weeks, and median 12 to 13 weeks. So 13 weeks is exactly a quarter, 3 months, and then 33 weeks is more like 7 to 7.5 or something months or something like that, right? So you can get an idea, like that's how long these corrections are. So then that gives you a sense, like that's how long of a time frame it has in order for the mood and momentum to shift that much. And then here are those actual drawdowns. Like I said, here are the actual market drawdowns for those particular events. And you can see that, yeah, between 75% of them are greater than 21%. And then, like I said, that's a percentile range, but the lowest one is 20.4% because I did the cutoff at 20%. But you can see that the median is 25%, 25th percentile is 39%. So that means half of them are greater than, or 25% or greater, and 25% of them are 39% or greater of declines. So very, very, very interesting, very cool stuff. And so also I have these little charts over here to kind of like visually illustrate somewhat of what I'm talking about here. Here I have the tops. What I did is I basically said like how correlated is the percentile metric here of these dates, and you can see that they're labeled for the dates of the correction with the drawdown. So that's what we have here on the x-axis is the size of the actual drawdown itself. And so here you can see that there is a correlation, a negative correlation between the value and the drawdown size. Meaning that like here you can see that the higher the percentile is, the bigger the drawdown is. And then the lower the percentile is, the lower the drawdown is. Now, if this line was more sharply sloped, then that means that it would be even better. And here it shows the R squared is 30%, which means that you're explaining about 30% of the positions of the dots relative to each other with the line does. The line explains 30% of the difference in positioning of the dots, essentially, is what that says there. And then down here, I kind of did the same thing with the bottom, which the bottom you can see does not correlate super well. It's only 4 to 5%, and it is positively skewed, which is not exactly what you really wanted to see, because you can see like the lower number or is skewed with the the bigger decline. So that means like if the decline is bigger, do you bottom out at a much lower level and it's a little bit weaker, a little bit less of a stronger correlation. And then here I have the actual difference, and the difference you can see is actually the stronger, even stronger than the top. The difference itself makes the biggest effect. Now, one thing I noted was that 2007 is kind of a weird one for a variety of reasons, because it's a financial crisis, which means is like, it wasn't because we were at a high valuation per se. It wasn't because like, I mean, valuation did play somewhat of a role, but in many ways, like the valuation story was a much bigger thing for the tech bubble, which was prior to that. And then the financial crisis was a little bit of a strange one because of the fact that it was a financial crisis. So one thing I found is that I did is that what you can do here is that if you just like kind of erase those lines for the financial crisis, just kind of like get rid of that one data point from the data set and then come back over, the relationship actually becomes a lot stronger. You can see that the top now becomes 55% of it becomes correlated, and you can see like they're actually much closer to the line now. And then likewise, the bottom is still doesn't really explain much whatsoever. But then coming down to the difference also improved to 36-37%. So only kind of a more marginal improvement here. Actually, no, wait, I think that's a decline from 43%. But it makes the top explain much better, which is one of the reasons why I think it's kind of worth noting, because otherwise it makes it seem like it's not as valuable. But the financial crisis was a little bit of a strange one because of the fact that it is a financial crisis. It's not like a normal recession. There was an actual banking institutional issue there. So anyway, very cool tool that I put together, like I said, over the last handful of months. And I've been looking at, like I said, it's really just a kind of a data monitoring tool. It's not really something to kind of, use as a timing tool per se. It's really just something to kind of look at and to be aware of, that if we were to start to go in decline, maybe you could expect higher declines because of these reasons. Like this is the kind of stuff that makes people have be in position where they're going to have to do like forced sells and like, causing more leveraging downward to the downside. That's kind of like the point of this. But like I said, there's some ways in which I wish to improve it as well over time. So we'll see if I do that over time, and I'll show you guys in the future if I do. So let's go on now and talk about the Fed. Actually, let's talk earnings first. I do want to talk a little bit about earnings. I don't really want to talk a ton about earnings today. We've talked about a lot about earnings in the last season, and some of the companies I'm more excited to talk about haven't released their earnings yet, but we have had some earnings come out for some of my companies. In particular, PayPal reported their earnings, which they had a pretty good quarter. They're in a very difficult industry and that's been having a lot of challenges, but I do think that they are doing a pretty good job of basically showing up and owning to basically what they have been guiding for. Like most of they've had ebbs and flows in terms of their guidance over the course of the year. But in general, they've whenever they've set out to do over the last really like since the new CEO has come in, they've set goals and they've been very, very good at actually executing on those goals. Now, what I will say is that there's kind of the difference between like what they say is some of the potential for their company, and some you might read those things as goals, but I'm talking about more like the specific numbers that they talk about in their guidance and things like that. And those types of things are relatively on target. And a lot of their comments in their calls over the last year and a half about flushing out some of the less profitable of overall accounts in their overall profile, and trying to really secure the more active accounts in their profile and make it so that they can continue to grow, but at a much more profitable basis. And I think they've done a really good job of that, generally speaking. So kind of like looking here at their Q3 snapshot of the results, you can see the total payment volume was up 8% year over year compared to Q3 last year, 7% on FX neutral basis, and then revenue 6% on FX neutral basis, which normally I tend to ignore when companies like to report like FX neutral revenue growths and things like that, I tend to not pay as close attention to it, because it's like, well, if you operate overseas, that's part of your business, then, currencies is just part of your costs. And if it works to your favor, sometimes that's also just part of the nature of the business. But because PayPal does so much currency transaction as part of their actual revenue, I think it's actually relevant for this particular one, because it does kind of like give you a more solid look through to what is a more operational revenue growth on a basis. So it's not adjusting the revenue for the value of their assets and their income statements. It's adjusting the revenue for essentially fluff to those transaction revenues based off of changes in FX costs itself. So it is actually relevant, I think, for PayPal, where for other companies it's a little bit more of an irrelevant metric in my opinion. But anyway, transaction margin, which is kind of like their gross margin for the transaction revenues in particular, and the TPV, 6%. Transaction margin excluding the interest on customer balances was 7%. So another kind of like adjusted metric, which personally I say just kind of leave it in. They're doing that to show that yes, the overall transaction margin is a little bit weaker, 6% versus 7%, but that's because we have to pay out on interest on customer balances, and essentially that's like a very capital inefficient part of their business, where they're holding assets on their balance sheet, the cash balances for their customers, and then they have to pay out interest, which is very, very low profitability for them. So that ends up being, it's like a low ROA investment. So that's why they kind of try to exclude it here. But whatever. Non-GAAP EPS, which I don't like their non-GAAP EPS compared to how I would do it, but it's not terrible for the most part, especially on kind of like a comparative quarter-to-quarter basis. So 12% growth is pretty good, and then adjusted free cash flow 48%, also very, very good. But the key part here being that they've raised their transaction margin and EPS margin or EPS guide for fiscal 2025. So they've been somewhat sandbagging the numbers all year, which has worked out very, very well for them. So that's kind of what I mean by them, for the most part, showing up to what it is that they said they were going to do, reiterating their free cash flow guide as well, 6 to 7 billion for fiscal 25, which then leads into the expectations about what they're going to do with buybacks for the rest of the year as well, that being a big part of the story. They also instituted a dividend this quarter. Very, very small dividend to be growing over time. They said that they're going to be targeting about 10% net income payout ratio for the dividend, which implies some very, very substantial dividend increases in the future to get there. Because I already kind of instituted that into my new model, but it's you really have to put some really large dividend increases in there to kind of get it up to that range. So for the most part, we'll see what happens with that. Which, the market reacted relatively well to that, I think, for the most part. But it is one of those things. They had a little bit of a pop up on the day, and then they kind of zigzag back down. You can see it actually shows a red calendar for it. On the earnings, they popped up, and then over the next few days, it kind of decayed back down. So it's hard to say necessarily if the decay back down is because people were digesting the earnings, or if it was because of the other kind of factors in the market thereafter a little bit. But the initial pop was quite high, and then it kind of gave back $10 a share pretty quickly on that front. But yeah, so then kind of coming down here further, looking at their actual payment volume across the different categories, percentage of total, obviously branded experience, online and offline, for being 31% of their TPV, and then Venmo being another 19%. For then their branded checkout line 29%, P2P and other consumer 27%, and PSP 45%. And then the growth rates, FX neutral growth rates, as they show kind of across these different categories. So Venmo, very, very strong growth. That's what we definitely like to see. P2P also very strong growth. That's fine as long as we can kind of keep it in the kind of more profitable category. And then here we see the PSP is actually kind of dropped down to 6% relative to what it was in 2024, which we had already kind of seen that in Q2 a little bit, but very interesting to see the drop significant portion relative to 24. This is the category that was a little bit less profitable for them, and it's one of the areas of their business where they were saying that they needed to kind of reshuffle their focus in order to get it to stronger, more profitability. So that, I think, is a big factor that's playing in there. But the real key part of the story right now is Venmo. That has been accelerating very, very much recently. So as long as they can pull that to significant profitability, that'll be very good for them going forward. Okay. returned 1.5 billion share purchases, 5.7 billion on trailing 12-month basis. Weighted average shares reduced 6% on 12-month basis, so pretty good on that basis. The 2025 guide, we had kind of talked about the transaction margins that they had raised and the EPS that they had raised. Here's the actual ranges for that. So implicitly saying 2 to 5% for Q4 growth, and then that becomes 4 to 6% growth on when you exclude that interest on customer balance, which personally, like I said, I think you should just kind of leave it in there. So 2 to 5%, non-GAAP effective tax rate. Okay, yeah, we don't really care too much about the tax rate part of it, but 7 to 10% EPS growth is what they're implying there for that, and that's the non-GAAP EPS. We can see here the GAAP EPS is not too far off from that. So for the most part, it's a fine adjustment in my opinion. But yeah, comparing the actual guide that they gave in 2020, the July 2025 versus October 2025, you can see that the transaction margin overall for the full year, they're raising it overall about 100 million on the low end to about 50 million on the high end, which is kind of interesting that it's a little bit lower of a raise on the high end part of it. But whatever, 5 to 6% doesn't really shift the percentage that much because it's kind of just more marginal in the change. But overall, the key part coming down to the non-GAAP EPS comes from 15 to 16% from 11 to 14%. So strong growth on the full year, which is pretty good. Looking at year to date, the stock has declined. So strong EPS growth despite decline. So you can see margin compression, multiple compression is what we're experiencing there. And then, yeah, they're still guiding for 6 billion in share repurchases versus what they're saying is 6 to 7 billion for the free cash flow assumptions. So that means that they're still theoretically going to potentially be building a bit more of cash, which means potentially more buybacks next year, or potentially just higher buybacks than what they're actually guiding for. They do also have 1 billion in capex. So PayPal looking good, still very challenging. And then, like I said, I am working through my valuations to a pretty significant degree, and PayPal is one of them that I'm definitely looking at. So I'll probably have new thoughts maybe on the valuation maybe in the next stream, because hopefully by the next stream I'll actually have gone through all my companies in much more finer detail about what I'm thinking about the assumptions going forward. But at least for this quarter, it was pleasant to see. Prior to the earnings, I definitely, for the last couple months, had been a little bit more negative on kind of the industry of PayPal, not on the company. The company, I think the company is executing as well as they can in the digital space, and I think the CEO is doing a good job. I just definitely think the industry itself is very, very competitive, and the idea that playing PayPal as kind of like a decent stalwart third player within the space is fine as long as the overall space is growing at a rapid pace. And the space is still growing, that being payment processing and e-commerce particularly, but it has compressed a little bit throughout some of the kind of the stresses this year, what with tariffs and kind of slow down in growth. So as long as we can kind of get back to a little bit of a stronger growth path, and or PayPal can kind of outperform on a more competitive basis, which isn't really necessarily the base case part of it, and or they can keep improving the profitability, which that part is kind of part of my base case, and they can continue to do the buybacks, which is also still part of the base case, then I don't see why they can't continue to recover back to where they were at the end of the year and the start of this year, when frankly I probably should have trimmed them. I know other PayPal bulls, or people who were bulls previously who were long during the same period as I was back here. I know people who unloaded up here and did quite well. So obviously, that would have been the smart move if I'd done so. But we'll see. It's like by the time we get back up there, I might be more bullish on them at that point again too. So, but like I said, I'm trying to give a fresh eye to pretty much all my valuations here over the coming months. So moving on from that, we also had Lennar report, which actually they reported like a month and a half ago, almost 2 months ago, because they report much earlier than most of the other companies. But I did want to comment on them because we did get reports of other home builders, and the home builders have definitely been languishing. It has definitely just been a very, very tough year for them, even more so than for PayPal. It's kind of in the same vein where it's the industry is just very, very difficult and struggling. And then, yeah, well, obviously they did have a period there where it looked like they were going to do really good, which was kind of following some of the talks by some Federal Reserve members that had given indications that they were going to be ending the balance sheet runoff and also essentially be lowering rates potentially at a faster clip. And so there was a lot more kind of bullishness kind of coming into the markets at this time. And then we had some resumed tariff concerns during this kind of period, as well as backing off of some of that kind of dovishness from the Fed as well. And so that's kind of what we've seen here is a little bit of, we had some strong recovery there for a period, but then it's now started to retreat. And then obviously we're down significantly from where we were last year, though I myself only started buying in around here, I think it was when I started buying. You know, I tried catching the knife a little too early, but it was early, and you know, I also bought my way down. So where am I actually on this one? I can't even remember off the top of my head, but we're actually about flat on Lennar. So that is what it is. But they have lowered their expectations for the next quarter relative to what the expectations were for the previous quarter as well. So that is a little bit of a downtrend, which could end up being sandbagging if we do start to actually finally get the turnaround in some of the economic data, which to be honest about it is the housing market looks really, really bad. But I am still basically convinced that it's not really likely to get too much worse. That's the thing, is like, I don't really think that the housing market can get a ton worse than it really is. The question is how long does the current period of not great continue? You know, it's like, I think we are essentially bottoming in a variety of the different types of like orders, prices, metrics, and things like that. And then it's really just sort of a waiting game of like, when does some of those economic indicators start to turn around, and then it creates a little bit of an environment where they can start to do well again. And so my sort of base case is that that's really going to be coming into the kind of like second and third quarter of next year, because that tends to be the stronger quarters for home builders, generally speaking. So we can go through kind of like a weaker winter and then probably come back around to a stronger next year. And then, like I said, I will be reevaluating all my valuations. So I will take that into context, and we'll see what I'm doing with the position in the meantime. It's like, do I wait for that, or maybe get out for that? And that's kind of the attitude I'm going to be taking with most of my positions, is like, yes, I've been trying to kind of like stick with these long-term theses that I have around a lot of these positions, but I might, for some of them, take the approach where say, hey, actually in the short run, we're going to get out, and then we're going to wait for certain indicators to start to show certain signs. Like I'll set certain goalposts where it'll be like, okay, if I see this and I see this and I see this, well, then maybe we'll come back around to that theme. And so that's kind of how I'm thinking about it, is I might do that for some of the positions. We'll see. And like Lennar might be one of those positions. Maybe not. I might just stick it out with Lennar. We'll see. But I kind of have a somewhat of a similar attitude almost about a few of them, to be honest. And then other positions I'm considering altogether, like Mastercraft. Like I do think there's still some potential to Mastercraft, but it's kind of a different position in my opinion, where it's really just based off of consumer trends and behavior, and it's not really a strong theme one for me. So the question is like, do I really want to sit around in that one? Maybe I'll just get out of that one. We'll see. So different thoughts on different positions, and like I said, I'm kind of reevaluating all my valuations here in the near term position. So coming over to the transcript from the Lennar call, it did have where was the part where I wanted to start? Let's see here. I'll start here. While our deliveries were just below our goal for the quarter, and while we sold more homes than expected during the quarter, these accomplishments came at the expense of further deterioration of margin, which came down to 17.5%. He's talking about the gross margin. So, and that being that they have been putting further incentives, which are essentially just like discounts to either the price or to the rate for the consumer buying. Essentially, they're basically giving them a discount to what the market would have provided them in terms of price and or rate. And that means that they have to eat it on the chin. So it's a lowering of gross margins for the industry. Accordingly, we're going to begin easing back our delivery expectations for the fourth quarter and full year in order to relieve the pressure on sales and deliveries and help establish a floor on margin. So, you know, they're lowering them saying, hey, we're lowering our expectations for delivery and full year, which is lowering our guidance, so to relieve pressure on sales. So basically what they're saying is like, hey, we've had these goals in place that are pushing our salespeople to make certain delivery numbers and sales numbers. And by to do so, they have to deteriorate the margin. And so we've allowed that to happen for a while, but now we're going to start to slow down that and say, hey, try to maintain the margin, even if it means slowing down the sales. And we will reduce our delivery expectations for the fourth quarter to 22,000 to 23,000 when That's deliveries for the fourth quarter versus 21,584 for this particular quarter, which was Q3. So they're saying that they're expecting to have a little bit more deliveries in Q4 relative to Q3, but a lower amount in Q4 relative to the Q4 of last year is what they're saying there. And then in total, that ends up giving a reduced full year expectation of 81 to 82,005 for the full year. This is an opportunity moment to pause and let the market catch up a little bit. You know, so that's what they're saying. It's like, hey, all right, we're gonna let the market relax a little bit in terms of our sell through and allow the prices to essentially find a better floor. Even though mortgage rates began to trend downward during the end of the quarter, stronger sales have not yet followed. I did actually pull up that. So here you can see, here's the 30-year fixed rate mortgage, and indeed, yeah, the mortgage rate has been coming down towards kind of throughout this last quarter here to a more significant degree here. It's kind of like the last year, so you can kind of see it much more fine detail. But obviously, we're still pretty up here on kind of 10-year basis, pretty high up. We got to technically a lower level in September of last year, so almost a year ago. We got to just a little bit lower before, as kind of the I think honestly it was the market starting to price in the likely outcome of the election was making mortgage rates kind of move back up here. But also you can see there was kind of these zigzagging here too. So it's hard to kind of parse out which part was just a zigzag versus which part was maybe some shifts in the market expectations a little bit, because there was an immediate kind of reflation kind of movement in a lot of markets where a lot of kind of like slightly higher inflation expectations, but also higher growth expectations were being priced into markets in the end of the year once it seemed likely that what the new administration was going to be. And then once the administration actually came in, a lot of the inflation part of that cooled off for a little bit while the growth part hung in there. And then by the time kind of like March to April began, then we started getting the tariff tantrum, which caused more mortgage rates to go back up a little bit. But then we've had growth scares since then too. So that's causing them to come back down. And then also we've had some cuts in the rates as well to a certain extent. So that might be influencing as well. So that's kind of explaining like the overall movements over the last year. We've had some zigging and zagging, but for different parts of the story causing it. But nonetheless, in the last year, we are significantly lower than we were a year ago. It's like 50 basis points to 60 basis points is what we've lost in literally a trailing year period. And then looking at it on kind of, you know, a multi-year period of since we've reached kind of like these peak levels, we've kind of reached these potential trough points around 6% or so, one in February 2023 and then one in October 2024, and we're kind of approaching that level here. So the point is, are we going to retest this kind of potential bottom point of where market doesn't seem to want to go below 6%, or maybe we will start to go into the high fives? The truth is that, you know, I can create scenarios by which mortgage rates can go down, but you know, I look at rates as sort of like on a comparative basis, generally speaking. So when I think about rates, I'm thinking about the overall curve and saying, okay, well, 30-year mortgage should trade a certain amount above a 10-year treasury. And then a 10-year treasury should trade a certain amount above a 2-year treasury, you know, and then the 2-year treasury should trade a certain amount above the federal funds rate, you know, like that's sort of the way that I think about all of these interest rates and like where they ought to be. As you can kind of look at historically, like what is the typical gap between these things and say like, okay, well, what do I think the gap's going to end up at? And if you're like going to look historically, the 30-year is, you know, 1 to 2 percentage points higher than the 10-year treasury, generally speaking. And so if I zoom in then and I look at it and say, okay, well, where do I think the 10-year is going to go? It's currently at just over 4%. I know that the current administration would really like to get it down to like 3% if they could or so, and even into the 2s if they could. We're talking about the 10-year, not the federal funds rate. So keep in mind the difference there. But I don't know. I also say that the 10-year treasury tends to track nominal GDP, which is a combination of inflation and growth. So from that basis, the 10-year treasury might be about where it ought to be. But then you can say, okay, well, that's 4%, whereas the mortgage rate is currently at about, like as we were saying, about 6%. And I was saying that the usual gap is like 1 to 2%. So if you say 1.5%, and then the 10-year treasury is at 4%, well, that means that the mortgage rate could maybe be at 5.5%. And I think that's pretty reasonable. So you could argue that the mortgage rate could come down to 5.5%, and I think that would be pretty reasonable. But beyond that, I don't know. It becomes harder to say how much lower the mortgage rate really ought to be. It could have a spread of maybe 1%. Like I said, it's like a gap of 1 to 2%. So maybe a gap of 1%, and then maybe you even get the 10-year treasury down to 3.5%, maybe at the very low end or something. Then you could say that that would create a 4.5% mortgage rate. But that, in my opinion, would be really, really pushing the long-term like placeability of that. Like, you know, there's what can happen in the short run, but we're talking about like, where is that rate going to be on average for 3 months, a year, 5 years, you know, because we're talking about like the housing industry. So that's what I would say. It's like, if you think that the 10-year treasury can get down to 3.5%, well, then you could see mid-4s mortgage rates. But if you think the 10-year treasury is right where it ought to be, well, then you should maybe be expecting like mid-5s mortgage rates. And then honestly, if you think the 10-year treasury is going to go up to 4.5% or even 5% because of inflation concerns and high growth potentially along with it, so we're just having like a strong run it hot economy, well, then at that point, mortgage rates are probably fine right where they are. If not, maybe they should go back up to like 6.5 to 7%. So that's what I would say, is like, it all depends on what you think the other things is happening with the interest rates. It's like, in my opinion, we could end up with a federal funds rate at like 2 to 2.5%. And then we could end up with a 2-year treasury at like 3 to 4%. And then we could end up with a 10-year treasury at like 3.5 to 5%, and then we could end up with a mortgage rate from like 4.5 to 8%. And you can see, by the way, like you'll notice that as I went up, the range for each one got wider, because essentially the uncertainty gets wider as you go up. Like, it's easier to maybe be more confident about maybe where the Fed funds rate is going to end up, but then you have to make a guess about each of those premiums on top. And then there's uncertainty around each one of those. So that's why I say it's like, we don't know. But and by the way, I'm kind of waffling back and forth on these things, but I would say my base case is that the mortgage rate will come down, because I do think that they will probably manage to get the 10-year treasury down a little bit more, maybe. Like, I think 3.5 to 4.5% is probably the likely range for the 10-year treasury. And we're just over 4%. So technically we're just over my midpoint, which means you could argue you could go a little bit lower. And I actually sort of think that it's maybe more biased towards like 3.5 to 4%. And that's not based off of market expectations. I think that there's going to be a lot of clever maneuverings and stuff to try to help get those treasury rates down to help fund the government. So it's somewhat of a political expectation I have there. But nonetheless, that is sort of my expectation, is that 3.5 to 4%, let's say 3.75 as sort of our base case assumption for the 10-year treasury. And then if I assume 1.25 on top of that, because 1.5 I said is maybe like the midpoint of the average, maybe we'll say a little bit lower on an average basis for that spread there, because they could also do things to kind of affect that. That'd be 1.25, and that would get you 5%. So you could see 5% mortgage rate like there. But in my opinion, that's like probably a generous but totally very reasonable and political potentiality. And so with that, if we're just over 6%, that means mortgage rates are going to come down, and that means that potentially this scenario will start to get better. But nonetheless, like I said, it's going to take time. It's going to take probably till mid next year until we really start to see those the Fed funds rate and the 2-year and the 10-year really start to like properly make their movements towards those terminal positions. And then that means it's going to take even more months for the mortgage rate to also kind of price itself out accordingly there. And technically for each and every one of those, they're all different markets traded independently. So technically one of them can start to price in that difference before another one does. But the point is, I'm sort of going to assume it happens in sequence, because that actually is essentially the more conservative assumption about that. But anyway, continuing here, because we did take a little bit of a detour there, we have certainly begun to see early signs of greater customer interest and stronger traffic entering the market. And yeah, I don't want to get into like a lot of the finer details, but as we've seen the mortgage rate come down just even a little bit, there is a lot of signs that there are people waiting on the sidelines for even just modest changes in mortgage rates in order to potentially hop into the market. And they're just waiting. So it's one of those things where we could potentially see that. It's just a matter of time to get there. But the point is, it may take some time before we actually do get there. The lower mortgage rates, purchasers are showing greater interest in considering their home purchase. This is generally an early sign of stronger activity to follow, assuming rates remain lower. Yeah, so they generally agree with that. But yeah, so that's kind of my thoughts on home building. Not a pretty quarter. The next quarter also might not be a pretty quarter, but I'm really more expecting that first quarter, second quarter, and third quarter of next year sequentially will start to really be improving. First quarter I think will start to be an actual improvement, but it's not going to be a great quarter. And the second quarter might actually be a pretty good quarter, but it may not be the greatest, and it could actually end up being porous. Whereas by third quarter, I think we really will start to see signs of life. But admittedly, that's a ways off, right? Like that's three quarters is a ways off. Admittedly, like I said, this is also like almost 2 months stale, this information here. So technically we're almost one quarter through that, but it is what it is. Hi, Olga. I saw you. Nice to see you. I didn't say it at the start. I'll say it now. If you're watching live or on the replay, please like the stream. Please subscribe to the channel if you're not already. Please hit the notification bell if you haven't already and you want to get notified whenever I go live or whenever I release other content like that. Also, the pinned comment in the chat, as well as in the description below, is a link to the free Discord. Come join the free Discord we have here. Takes a few hours to a day or two to be let in, so be patient if you do enter the Discord, because you do have to manually be let in. You'll be put on the landing page. You can message myself or a moderator when you're on that landing page, but nonetheless it's going to require somebody to manually let you in. So until somebody does, you kind of just have to be patient. But when you do get in, you can be part of our daily discussions, what we got going on in our own portfolios, what's going on in the markets, talking about what's going on in the economy, actions of major investors or other interesting actors, and academic research, and even just some memes. So come be part of the discussions there. Like I said, for free, but you do have to wait to be let in. So moving on from Lennar and PayPal, let's talk a little bit about Generac. Stretch a little bit. So Generac had not a great quarter themselves, missed on their estimates. Hold them up. Missed on their estimates, both revenue and earnings. Pretty significant decrease in particular in their residential products. Decreased approximately 13% compared to the same quarter of last year, almost 100 million less. On the basis of 600 million. So not super good. The overall net sales was a 5% decrease. So it's 13% in just the residential category. 5% of the overall net sales decrease, just to be clear on that front. And you can see like 1.11 billion versus 1.17 billion. So that's 660 million is less right there versus the approximately 100 million decline there. So that just goes to show that the commercial industrial actually essentially buoyed the decline to a significant degree. There was an increase of 9% there, of about 30 to 40 million increase there. So yeah, strong increase in commercial industrial, and then a little bit of decline in residential. In the details, they specifically say that it was below expectations as a result of power outage environment that was significantly below the baseline average in the lowest third quarter of total outages since 2015. So a little bit of a particularly weak outage hours kind of quarter. I do know that there has, since the end of the quarter, been some storm activity. So maybe we'll see a little bit of a pullback from that as well relative in the fourth quarter. And then also, I've talked about it before, the kind of correlations of the outage hours per customer in US utilities to the revenue growth rates for Generac. And I'm bringing that up because they had very, very strong outage hours last year. And I was even talking about it at the end of last year and beginning of this year, that I thought that was a pretty good sign that depending on some of the other factors, we could see some good strength this year. So we had weak outage hours this year, and then we had strong outage hours last year, and I almost would have expected stronger sales this year because of that. But I do think that the lack of decline in interest rates was one part of it, because I do think that that plays some tail in terms of like when people are planning for those types of discretionary home purchases and stuff like that. It goes in with the home building things. Like if there's less people buying homes, there's going to be less people buying furniture, appliances, and generators potentially for their homes. They're not 100% connected, but they're somewhat connected. But even a bigger factor for them has been tariffs and a lot of the kind of disorganization around that, because they do have to get a lot of various inputs, both electrical inputs and then commodity inputs from outside the country. So that is an impact for them, and they've talked about it in their guidance as well. So that is a big factor. But then also, like I said, with the C&I sales, we talked about previously how they had a kind of a gangbusters previous quarter because they finally had come out with their data center large scale megawatt generators, and that had finally hit the market. And within hitting the market, they had built up $150 million backlog for those products. So the kind of what I would say the big caveat to this for this quarter is that, yeah, a very, very weak residential quarter. But like I said, my modeling for the company is really kind of based around the kind of long-term expectations around the home standby generator space and the outage hours per customers. And so I'm actually not very concerned about what happens in one particular quarter for this at all. I would be concerned if we were getting into like a 2 full year period where it seems like there's been a significant breakdown of outage hours compared to the actual sales, because otherwise it just looks like fluff to me. So very, very bad quarter, but really has basically no impact on my perspective of the thesis and like how I built the model for the company. And in fact, really positive things for my thesis around the company because of the commercial industrial parts and that backlog, because for this quarter, they've actually doubled that backlog from 150 million to 300 million. I think they mentioned it in here. Yeah. The third quarter also included initial shipments of the new large megawatt generators to the data center market. So previously they had started actually taking sales for them, but now they've actually started to ship them, which is good because that means technically there was a decrease in the backlog, but then they actually managed to increase it further. We continue to develop a pipeline of opportunities with our backlog for these products doubling over the last 90 days. So yeah, really, really cool to see that backlog double, even though there technically would have been deliveries in there. So technically that 150 million should have gone down a little bit. I don't know how much it would have gone down. It could have gone down a lot. It could have gone down almost not really much at all. It could have just been like a couple million. But nonetheless, that implies that they essentially brought in more new business to the backlog than they actually delivered in the quarter. So very, very cool. Very, very cool. And that's just to go from 150 million to 300 million. And then also keep in mind then that the commercial portion of their business is, let me actually take the percentage, because I keep like saying different numbers to different people, because so 627 plus the CNI is 358. Shit. Wait, that doesn't actually, oh, it doesn't have the other category. That's why. Okay, I should just use the 1.1 billion. I was thinking like, that's not the right amount. 358 as a percentage of 1.11 billion. That's what I wanted to do. Because it's not reporting the other segment here. So that's why it's missing a chunk. Yeah, so CNI as of this current quarter is 32% of their current revenue mix. 32%. And then 32%, again, 358 million. And it was 150 million was the backlog last quarter, and it's now 300 million. And so that's for that's for the megawatt generators. Keep in mind, they have other portions of the commercial industrial business. So that 358 million is not megawatt generators, right? Like they may have delivered a few of them in this quarter. So I don't know what percentage of that, but it probably wasn't more than like 5 or 10% of this 358 million that was actually the megawatt generators being delivered. I'm totally making that number up, but it probably really is like not more than that. So the point is that like this 358 million is the other CNI business for the most part. Like let's say 300 million of it is, and then they had their backlog go from 150 million to 300 million, which means that for that portion of their business, like, is already a backlog that's almost the same size as their quarterly portion of the revenue, right? Which is 32% of their sales. So my point being is that, like, if they doubled their backlog in a 3-month period, if they could double their backlog like 2 more times, which would be an 8-tupling in total, then essentially they would have their entire commercial industrial business covered for a year. They would have a year backlog on their commercial industrial business, which is just awesome. And now obviously, like, orders can be canceled. So like, that's one thing, obviously, the complications with backlogs, but like what it also creates is predictability in the revenue growth rates. Now, I feel very, very confident on like the long-term growth rate for the residential business. And that's sort of what I mean about the kind of like my long-term assumptions about the model, and me not really being concerned about the variability in the short term. But I didn't ever have very, very strong clarity on the long term for the commercial industrial portion of their business. And now with them giving like a much clearer understanding last quarter of the TAM size of the market they're going after, that helped create some clarity around that. But then this quarter, but by them seeing how fast they can grow that backlog, what it also does is it creates a much more confidence and clarity in the short-term revenue growth rates for the commercial industrial business, right? Like, this is the reason why Microsoft has such a super stable stock price when you look at it, right? Like, you go and, like, I mean, over the long run, obviously, like, if you zoom out and you look at this and you look at it and you're just like, wow, man, this thing is just shooting up and up and up. Why is it? Yeah, obviously it's variable here, but nonetheless, it's just going up and up and up, especially in like the period prior to 2022, when we had kind of more changes in the market. But like, this period right here was them shifting to the subscription model, right? Like, them shifting the subscription model of their business. And the reason why that's valuable is it creates predictability in the revenue growth rates. So that's what I'm saying, is that I think that this growth and backlog for Generac is essentially going to be smoothing out the growth rate over time, which essentially should lower the beta, so to speak, that the market implies on its stock price. It should trade for a higher multiple, essentially, is what I'm saying. Like, PE ratios are driven by expected net income margins, expected EPS growth rates, and perceived risk, often measured through some sort of beta measure of some sort. Beta usually is obviously like a price volatility, but the price volatility is essentially meant to be a proxy for fundamental volatility at the end of the day. And so that's why I'm saying here is that fundamental volatility goes down with this kind of shift in their business model. So it'll be really cool to see. Like I said, I want to see that trend continue. Like, 300 million of a backlog, that's cool, but that's not enough to make a big impact on how people are going to price your stock. And then obviously keep in mind that well, Generac is already priced very nicely, so that's not to say that like they're going to get some big boost to their multiple or anything like that. But nonetheless, the idea of a multiple compression for Generac is definitely a major concern to have, because they are priced pretty richly, pretty accordingly. I don't want to switch away from this too quickly, so let me just pull this. All right, like, let's. Look at that PE ratio, right? Like, it's a pretty volatile PE ratio. Just looking at in the last 5 years, for the forward PE as low as 10 for the and as high as 44, for a trailing PE as low as 13 to 14, as high as 78 to 79. You know, and this is on a company that did not go unprofitable, you know, at any period during that time frame. So, you know, and, you know, you can say, oh, well, maybe that period was just really volatile. It's like, well, let's zoom back into the other period, the other 5-year period we weren't looking at. It's basically not really that different, to be honest. It's a little bit lower in the absolute heights, but also the low end is a little bit lower too. So the multiple has simply come up for the stock over that time frame. Basically my point. And so, you know, looking at this, like, you know, we have to think about like, what is the terminal multiple you might assume for the stock. We're currently trading at a forward multiple of 22. I think you know, it depends also on what you're assuming about the growth rate in year 10 at that terminal level. But if you're assuming still like, you know, economy growth rate, like growth rate, so not slower than the rest of the market essentially, then I don't see why they wouldn't trade at like a pretty typical market mature multiple, like a 17, 18 themselves. But if you assume lower growth rates, maybe it's closer to like a 15 or something. But the point is like, we were at those multiples earlier this year. In terms of the forward PE, we were at those multiples in 2013 or 2020, 2023. But the trailing, you can see, is so much higher. And that comes down to that expected growth rate. Like, that's the difference, right? The difference between the trailing multiple and the forward multiple is the expected growth rate. So that's basically what I'm saying, is that this compression in that expected growth rate you're seeing here, you don't see as much compression if there's much less volatility in that actual growth rate. People will have much higher confidence that, oh yes, there really is going to be 5% growth next year. Oh yes, there really is going to be 10% growth next year. So that's really kind of like where a huge improvement on that front comes. So coming over to the 2025 outlook, they did, like I said, have a pretty weak quarter themselves. And so the 2025 outlook itself is also being lowered. So that's where, like I said, it's like the stock itself didn't have a great time of it, because yeah, the quarter was kind of ugly. And so the question is like, well, what is the punishment for the current underperformance relative to what the previous expectations were versus the resetting of expectations on the new future? Because yeah, we missed this quarter, but that's now the past, right? Stocks are priced on the future. So yeah, there's a decline here. We did get a chop down back to the mid 60s compared to we were back in the 90s. We've obviously had some zigzagging here a little bit. And I had people ask me in the Discord if I want to buy more. I would love to buy more, but it might have to be lower, more like below 150 or something like that. Give me back here. That was where I was buying previously, was back below 150 or something. So, it might not be too much different there, but like with all of my stocks, I will be reevaluating everything and rethinking the value in different ways. So we'll see about that. Coming over to, is there a couple other comments in the call they didn't already kind of talk about? Now let's talk about some of the details here. International total sales increased 11%, driven by continued strength in C&I product shipments in Europe and the first shipments of our large megawatt generators to the data center customer in Australia. To a data center customer in Australia. I'm going to have to look into that, try to see if I can identify who that is. We're going to be looking for these kind of hints for things like that, because then that gives you the ability to then go look at that customer's financials maybe, and kind of create a way to track what's going on behind the scenes a little bit. But we'll see. I'll have to look at that. International sales continue to benefit from the favorable impact of foreign currency, yada yada. Additionally, international EBITDA margins expanded at a strong rate from the prior year due to a favorable sales mix. So high demand for the products means you get to set the price. Our initiative to penetrate the large and rapidly growing data center market continued to gain momentum, with initial shipments to international markets beginning during the third quarter, as we saw our global backlog of large megawatt generators for this important end market doubled to more than 300 million over the last 90 days. First domestic shipments of these new large output generators began here in the month of October, which would be after the quarter, right? So 4, 5, 6, 7, 8, 9, 10, 11, 12. So that means therefore that any like I said, first shipments to Australia in third quarter, but then we're going to have shipments to US customers in October. We're projecting a strong sequential growth in sales to the data center end market during the fourth quarter. Strong sequential growth. The large majority of our backlog is expected to ship in 2026. The large majority of our backlog is expected to ship in 2026, and that's after it doubled to 300 million. So large majority. A majority is 150. What's a large majority? 200, 250? Let's assume 200. Let's assume 200 million is going in 2026. Again, that is on top of the previously existing C&I revenues. If we assume, like I said, and based off that logic, I'm going to assume even less. Oh, because like I said, I was looking at the what was it? the 358 million. I said, well, maybe 58 million of that was the data centers. I'm feeling it's even less now. I'm feeling like it's even less now, like probably more like 325 of this is the previous CNI. So 325 previous CNI. Let's throw 200 million of backlog, or like I said, yeah, 200 million backlog onto there. That's 550 million. 550 million in CNI revenues. 550 million in CNI revenues. Let's take oh, this is the quarterly. That's the quarterly. My bad. I'm actually looking at the quarterly numbers. I'd have to adjust because they're talking about the full year number. So yeah, I don't have the full year numbers here in front of me, but let's just assume 300 times 4, throw 200, 14 divided by 12. This is a much more spitball way of doing it, but it kind of gets to the point. So assuming no growth in the other portions of their CNI business, they're implying like 16 to 17% growth in CNI next year. If you assume that there's like 5% growth in the rest of their CNI business, then that's probably going to be closer to 20%. And then if you assume like 5% growth in the residential portion of their business, then let's see, that's going to be like this times 32 plus minus 32 times, let's say 5%. It was that. It was that. So yeah, 13%. So you could see double-digit growth for Generac next year, most of it coming from the data center space. Assuming that you saw 5% growth in the rest of their business, basically across the board, then you could see double-digit growth in Generac next year, based off that. Let's actually go see how that. Okay. Analysts are projecting 11% growth for 2026, and I had 13%. I assumed 5% for the residential business. If you assumed a weaker for the residential business, you know, or something like that, you could end up with that. So you can see like where the numbers come from. Like this revenue is probably pretty dependable. Is basically what I would say. It's like that's probably a pretty dependable number. What happens with earnings and margins and all that, you know, that's a much bigger question, obviously, because tariffs and all that will continue to be in effect. But yeah, very, very cool. Very, very cool. If you just read the details there. And then, yeah, like I said, I'm going to have to try to do some PI work to figure out like some of these data center customers in particular, if we can. That'd be really, really cool. But yeah. Oh yeah, and then they say here, importantly, we continue to develop a robust pipeline of new opportunities within the data center market, representing a significant upside from our CNI product in 2027 and beyond. So yeah, them indicating that this 300 million is not necessarily the end of the line. Now the question is like I said, like 300 million, and if we're assuming 200 million of it goes over the next year, then that means you would assume that 75 million of it would disappear over the course of a quarter, and that's sort of giving no credit to Q4. So it's actually taken into fifth. So that'd be 60 million. So that means in the next quarter, theoretically, you could assume that the backlog would drop by like 60 million if they were delivering it in equal chunks, which maybe they're not. Maybe it kind of gets back ended towards like the mid to latter half of 2026 is maybe when the majority of it gets delivered. So no, we don't really know that for sure. But the point is that you would theoretically see this decay, if not next quarter, but then the quarter after that by potentially 50 to 100 millions worth, right? And so the question is, if this backlog manages to grow by a similar amount, being 150 million as it did this last quarter, that means it would go up to 450 million, but maybe that gets cut down to 400 million. So the point is like, if we see 400 million as the backlog next quarter, then I would say that would be theoretically basically a same pace of pipeline development, if that makes sense. So yeah, you can kind of think of it in that way. Data center power demand is forecasted to grow at a significant rate for the foreseeable future, and high uptime requirement for these facility drives backup power needs in excess of site electricity consumption. Third-party estimates suggest that global data center demand will cumulatively grow by more than 100 gigawatts over the next 5 years, with the potential for incremental annual capacity additions to double by the end of the decade. Huge market opportunities existing data center spaces. Uh, da, 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 yeah, here, one of the other things they said here. We expect to undertake several important capacity expansion related projects. So CapEx coming and or acquisitions coming and investments during the fourth quarter. During the fourth quarter. So some potentially large amounts of CapEx coming in the fourth quarter. You might have to think about that in terms of cash flows. As a significant producer of these products and well beyond 2026 to support what we believe could be a potential doubling of our C&I product sales over the next 3 to 5 years. So I was just talking about an increase of 200 million over the course of 1 year, whereas they're now saying that they're seeing, I was saying 200 million over the course of 1 year. They're saying a potentially another 1 billion over the next 4 years after that is what they would see there. 1.2 billion up to 2.4 billion 5 years hence. Which would be, that'd be like a 25% increase to their overall revenues right there in a 5-year period. And again, that's not taking into account any growth from the residential. That would be with zero growth from residential. So assume 5% annual growth from residential in there, and 25% over a 5-year period annualized is like 3.5 to 4% compounded. So 3.5 to 4% compounded plus like 3.5 to 4% weighted. Yeah, so you'd be seeing like 7 to 8% compounded over a 5-year period for revenues of Generac right there. Yeah, so very, very cool, very, very cool. They also did, I kind of skimmed past it. I didn't see where the comment was in here, but they did also mention that they had continued strength in the Ecobee, also continuing to still likely provide positive EBITDA contribution by year end. So that's good. That's been a loss leader for a couple of years. So another other category of their sales that's continued. Oh, here it is. Yeah. Grew to approximately 4.75 million connected homes, expected to deliver positive EBITDA contribution for the full year. So yeah, also still very cool. So yeah, that's pretty much my thoughts on Generac. Like I said, weak quarter in terms of the actual numbers of that quarter. Like it was a pretty ugly quarter. But in terms of like the forward looking, the thinking about the future and thinking about like what's happening with the future of the company, it sort of only got better. It sort of only got better. You could argue that we are still potentially, seeing a slowdown in the residential. So, that's going to be maybe a kind of a moderating factor over the next year or two. But analysts are seeing kind of double digit together. If you combine both these years together, it's double digit compounded for at least the next 2 years. And like I said, I think it could be like more like 8% or something over a 5-year period. And I don't think my current valuation in here has that. Yeah, I got 6.8% compounded for 10 years. I got 8.9% compounded for 5 years. So yeah, okay, I do have the growth in here for that, but I also have it not in the first few years. So I'm sort of back ending that a little bit. Though, like I said, I'm going to be adjusting a lot of the assumptions in these models for now. So, all right, that's earnings. That's talking about earnings. That's all the earnings stuff I wanted to talk about. Now let's talk a bit about the Fed and liquidity. Things are getting a little dicey out there in some of the financial markets, institutional markets, liquidity markets, and things like that. Things have been getting a little dicey. I'm not even sure where to begin. I don't know how to talk about that today. Where to begin? I'm not talking about this either. Okay, so this week we had Federal Reserve lower the federal funds rate. I have the federal funds rate out here separately somewhere. I did. Did I not? I thought I opened everything I needed, but maybe not. All right. The Federal Reserve, here's their hiking cycle. They lowered some rates mid last year. Then they held them steady. Lowering rates upset some people. Holding them steady upset some other people. Lowering them again upset some more people. Raising them this much upset a bunch of people too, if you'll remember. So, you know, no matter what the Fed does, they upset people. That seems to be their lot in life. I often say Jerome Powell has the second hardest job in the world after being the president. So, you know, is what it is. But yeah, they did on Wednesday, they announced it, and then Thursday they did it, dropped the federal funds rate down. So now that's where we are. That's great. But what I will say is that they also tend to make announcements about what they're going to do with their balance sheet when they make these announcements. And most people don't pay close attention to the balance sheet stuff as much. That's definitely more of like the financial wonk kind of stuff to look at. But I am a financial wonk, so I look at them. Here you can see conduct standing overnight repurchase operations, minimum bid 4%, aggregate operation of 500 billion. Okay, standard stuff. Standing overnight reverse repurchase agreement operations 160 billion per day. Okay, standard stuff. Okay, the interesting stuff. Roll over at auction the amount of principal payments from the Federal Reserve's holdings of Treasury securities maturing in October and November that exceed a cap of 5 billion per month. Redeem Treasury coupon securities up to this monthly cap, and Treasury bills to the extent that coupon principal payments are less than the monthly cap. Beginning on December 1st, roll over at auction all principal amounts from the Federal Reserve's holdings of Treasury securities, and then reinvest the amount of the principal payments from the Federal Reserve's holdings of agency debt and agency mortgage-backed securities, MBS, received in October and November that exceed a cap of 35 billion per month into Treasury securities to roughly match the maturity composition of Treasury securities outstanding. Beginning on December 1st, reinvest all principal payments from the Federal Reserve's holdings of agency securities into Treasury bills. Allow modest deviations from the stated amounts for reinvestments if needed for operational reasons. Okay, so what was all that jargon? What did all that all mean? Okay, so what we've been doing is we've been decreasing the Federal Reserve's balance sheet, right? We had increased interest rates. Everyone knows about the increased interest rates, right? But we were also decreasing the balance sheet. So what that means is the Fed, which holds a bunch of securities, largely treasuries, either federal treasuries or mortgage-backed securities. That's basically the vast majority of what they hold on their balance sheet is those two things. And so they've been selling both of those things over the course of this time frame here. And we went from almost $9 trillion of a balance sheet in early 2022, or really like mid 2022 is where it peaked, because this part took some time for it to really kind of line up with the payments. And then we had a little period there where we had to kind of give a quick injection to help things, but then we continued on the pace, and we've decreased from almost 9 to about 6.5. So the Federal Reserve has sold $2.5 trillion worth of treasuries and mortgage-backed securities over the last 3 years. And so you have to kind of think about, like, what does that do, right? Like, first of all, like, why does the Fed buy them, right? Like, why does the buy them? That's what they call quantitative easing and quantitative tightening. When you're easing, quantitative easing means you're trying to make the numbers easier, right? Quantitative means number, dollar, price. And specifically, that's what they're doing, price. They're trying to hold up the price of something by buying it. So essentially, they were doing a buyback, you could say, of treasuries. Now, we don't think of it as a buyback because we think of the Fed and the Treasury as two separate things. But, I mean, they're both government financial agencies, where they're independent or whatever. It's like, sure, whatever. You can say that all you want. But at the end of the day, it's the apparatus that funds the government. So they're not really all that separate. They operate separately, and they have all sorts of laws and rules that keep them separate. But in terms of like power and like international world power and how like actual power works, they're not really any different. Which is, by the way, why I think a lot of the discussions about Fed independence is kind of a silly topic. Like, yes, we do try to preserve what we think of as independence, but it's not real independence. It's very, very conditional, tangential independence. And the way you know this is if you know your history, because the truth is that like the Treasury Fed Accord, which is the agreement that put in place what we think of as Fed independence, was put in place in like the early 50s. And then there was major significant challenges to Fed independence at various points along the decades since then. So it's like it's not something that has always existed. It's something that has evolved. The Fed itself is an institution that has evolved over time. So independence is something that we like, but the truth is that like when you're in the crisis period, there is no independence. The Fed was not particularly independent from the Treasury in 2020. They were working together to make sure that all the money made it to all the places that needed the money during the crisis. And that was what the Fed was doing, and the Treasury was a part of that. So it's like there wasn't really independence in 2020, just like there wasn't really independence in 2008. So yeah, it's like, okay. But nonetheless, we do try to have this thing of independence. And it, like I said, it's a thing it's kind of essentially like an illusion that we play to during the good times. But then the bad times, we kind of toss it out the window for a period of time. That's what I would say. And so within that vein, when they're easing, they're buying the securities to try to make it easier for the prices to be held up. We want the Treasury security prices to be held up. And then when you're tightening, that means you're selling. And like when you're selling anything, prices tend to go down. And so that's what we were doing here, is we were raising interest rates and selling treasuries to essentially force prices down, yields up, prices down, inflation down. But as you can see here, that pace started to slow. So as the interest rates started to level off, we kind of reached our peak point of the rate here in mid 2023, and then we started to decline them in mid 2024. So if you come back over to the balance sheet, you can see that kind of mid 2023, just like around here or so, this is kind of the point where the slope is kind of the steepest down. And then slowly after mid 2023, which is the period where we stopped raising rates, the rate at which it decreased starts to slow, starts to get flatter and flatter and flatter until mid 2024, which is when we start lowering rates. So we start lowering rates, but now we start decreasing, but still going flatter and flatter and flatter. So the way you think of this is that like this supplies liquidity to the market by lowering interest rates. It lowers the discount rate, which raises prices, and that's where people are worried about like blow off tops and bubbles and things like that, and inflation. But then you have to think about, well, there's the other part of what's been happening, which is the tightening part that's still been happening. So we had an easing part with the interest rate, but we still had a tightening part going on with the balance sheet. And that's basically what they're saying is going to end, is that they're going to reach the period here on December 1st, where they're going to stop allowing that rollover to occur, where there's a decrease specifically of treasuries. They're going to stop decreasing the amount of treasuries in the profile, and they're going to allow the mortgage-backed securities to continue to roll off. But then they're going to take the dollars that they get from the mortgage-backed securities rolling off, and then they're going to reinvest them in treasury bills specifically. Now, they specifically say bills, not just treasury securities broadly, because it's worth noting that's an important aspect too, is like what type of treasuries do they hold? Do they hold long-term treasuries, or do they hold short-term treasuries? And the Fed actually holds relatively longer-term treasuries. I think the average maturity on their portfolio is like 7 to 8 years, because they own a ton of 3-month bills and a ton of 2 years, and then a huge amount of 10 years, I think it is generally. So that's the thing, is like they're basically saying, okay, we're going to stop selling the 10-year treasuries. By the way, selling 10-year treasuries puts upward pressure on 10-year treasury rates. So they've been selling treasuries through this entire period right here, which causes rates to be pushed upward. And remember, they were actually selling them at a faster rate during this period right here. They were selling them at a faster rate during this period here. Then they slowed down the rate at which they were selling them during this period here. Then they slowed down the rate at which they were selling them even more here, while also lowering short-term interest rates during this beginning during this period here. And that's where we've kind of seen, well, you can see obviously technically it went up first because there was some inflationary concerns, but since the inflation concerns, there's been a little bit more of a consistent downward trend in the 10-year treasury. Now we'll see how consistent this 10-year treasury downward trend tends to be if we can get past some of these kind of like previous low points that we already had, or if we can also continue on for a long enough period of time that this doesn't seem just kind of like a temporary zigzag. So we'll see in another like 6 to 12 months, really, what's really happening here, if this is actually a downtrend or if this is just going to kind of hit some sort of like bottom point, and then bonds will start to sell off again and yields will go up. But again, that kind of plays into what I'm saying here, is that they're saying we're going to stop selling treasuries altogether, the long-term treasuries, and then we're going to start buying using the mortgage-backed securities that we are still selling. We're still selling mortgage-backed securities, but now we're going to buy treasury bills. And now the reason why that matters buying treasury bills is because the also you have to keep in mind that what the Fed is planning to do is they're planning to continue lowering the interest rates, especially after Chairman Powell's term ends, and then we get a new Fed chair that is theoretically going to lower rates even more, like the administrator wants. And then by mid-time next year, they plan to essentially refinance as much of the federal debt as possible on the short end of the curve with the lower rates. And then what that's going to do is that they're hoping that that's going to get them lower interest costs in the short run, but it's going to create a need for them to refinance the debt again only like a year or two later in 2027. And by that point, they hope to then have the 10-year treasury even lower. So that's what they're doing. Like that's basically the plan here, is that they're the treasury, the federal government, the presidency is trying to essentially get short-term rates down, the federal funds rate down in the next 6 to 12 months, so that they can then refinance all the debt on the short-term end, because you're then essentially creating large supply on the short end and no supply on the long end, then that means that the people who do want 10-year treasuries won't be able to get them, which means that the price is going to have to go up. And if the price goes up, it means the yield goes down. So you see that they're playing essentially like a short to mid-term supply and demand game to essentially try to manipulate interest rates to where they want them to be able to finance the rates when they want to be able to rate. So yeah, mid 2026, we finance as much of the government debt as possible on like a 3 to 1 year kind of duration. And then that means, because of that, means that in mid 2027, you're going to have to refinance again all of that debt, not to mention any new debt. And then by that point, they're hoping to essentially have starved the 10-year treasury supply from the market. And if they starve the 10-year treasury supply enough, then even though there's concerns about inflation and potentially high growth expectations, which means higher rates, then they will maybe not have rates actually go up all that much. In fact, they might even be able to get them to go down to a certain extent. And like I said, that'll be based off the inflation concerns. But if there's growth concerns at the same time, that will also cause the 10-year treasury to go down, because growth concerns tend to cause 10-year treasuries to go down. So if people are pricing in a recession next year and rates are cut in mid 2027, if people are pricing in a recession late next year to early 2027, but before then they manage to cut rates enough and starve the 10-year treasury, then that means they could actually refinance the government debt at lower rates. Again, this is a tricky game. Like I just explained like the plan, but it should be clear that whether or not that works is anybody's guess. Like it certainly could work. That certainly could work, but there's like I can give you a handful of wrenches that could totally be thrown in that plan. Like the whole idea of trying to starve the 10-year treasury supply to get the rates to come down. Like that could work, but there's plenty of things that could totally impact that in a negative way. And then, like I said, that also depends a lot on the growth and inflation expectations over that 1 to 2 year period as well. So yeah, very, very interesting situation that we have going on with that. And then it's worth noting that also that when they lowered the rate this week, some of the comments from Chairman Powell was that we shouldn't take the rate cut in December as a foregone conclusion. And previously it was being priced in as a foregone conclusion, and now it is no longer being done so. Now it's only a 63% chance that we're going to get a rate cut in December, and then it's expected that we're not going to get any rate cuts after that until the June meeting on a kind of a median probability basis here. So like this curve has come up when previously it was a little bit more of a downward move like this. So it's come up a little bit since the meeting. So on one hand, that's probably a more conservative way for the market to be priced. But on the other hand, if it's accurate, it means a lot less of this could work out, because but again, it's also based on the pricing right now. If we get to mid 2026 and Kevin Hassett becomes the new chairman of the Federal Reserve, and Stephen Myron is now a permanent member of the Federal Reserve, and another Trump favorite becomes a governor of the Federal Reserve, well, then maybe we really will have the Fed funds rate cut down to like 2%, 1.5% or something, which would completely shift that dynamic around pretty significantly. So that's talking about the Fed. I said we were going to talk about liquidity, and then I really just talked a whole lot about the Fed and the kind of the game plan between the Treasury and the Fed and the federal government. Because, well, frankly, I felt like we needed to explain a lot of those things to explain kind of the potential liquidity concerns we're currently have going on. I don't want to call it a crisis yet, but it's definitely concerning. So here, looking at the federal funds rate, you'll see that when they make changes, it bumps up and then it's flat, bumps up and then it's flat, bumps up and then it's flat. Because this is a rate where, I mean, they technically set a range, but there's various complicated metrics and aspects of how they control it. But they have very, very strong control over this interest rate. It does not tend to move very much because there's essentially strong market incentives for people to buy and sell treasuries and other securities at various spots that basically forces the rate to be exactly where they want it to be. But it's not perfect. And that's what we're about to talk about. You can see like there are moments where it deviates around. I can see like 1 basis point off here and there, 1 basis point off here and there, 1 basis point off here and there, 1 basis point off here and there. But then if you zoom in to where since we started cutting rates, that's where things start to get interesting. Still fine. All the way through this period of 2025 where they had stopped cutting rates because they cut rates a couple times at the end of last year, but the treasury rates started going up at that exact same time. And so the Fed, it looked like, took the message to say, oh, if we're cutting rates, the treasuries are going up, not down. So we should actually probably stop cutting rates. It seems like they sort of took that message. That seemed to be the message that the market was sending them. But as you know, obviously in the last few months, the Fed has started cutting rates again. And the question is okay, well, what's gonna happen there? Well, the rate hasn't really gone up. The 10-year treasury hasn't gone up, but again, we've had growth concerns during that time frame too. So we hard to parse out. But one thing we can see is that there's been a lot less stability in the Fed funds market since then. So like looking here, you can see we dropped down 1 basis point up, 2 basis points up, 3 basis points up, 4 basis points up. So what's up with that? We cut rates in September to 4.08. And yet by the time of the next rate cut, they had risen from 4.08 to 4.12. So 4 basis points up. And that may not sound like a lot. That may not sound like that matters. But you have to understand that there are large institutions that fund billions and billions of dollars, hundreds of billions, trillions of dollars on interest rates based off of these basis points. And then they leverage them up 50 to 1 on the assumption that these ranges are going to be extraordinarily tight. So the idea that it's shifting up more than even 1 basis point basically shows you that the Fed is actually starting to lose control of the short end of the curve here a little bit. And like, so you think, okay, what causes that to happen? If a rate is going up, it means people are not buying enough of the security. If they're not buying enough of that security, it implies that they are buying something else, or they don't have enough cash in order to buy the security. So if they're buying enough of something else, what else could they be buying? Well, if it's not a super short-term treasury like a 1 month treasury bill, which is kind of the thing that you would be funding with the effective federal funds rate, then maybe it's a 10-year treasury. And let's look at the last couple months, the treasury rate has been coming down. If the treasury rate is coming down, that means people are buying treasuries. And if they're buying treasuries, it means that they're not buying short-term, if they're buying long-term treasuries, it means they're not buying short-term treasuries. So you can see like that those two things are actually going together. Long-term rates coming down, potential lack of control on the very, very short end of the rate market here. And now you might say, okay, like this is, Midas, what are you talking about? This is like such minor little details. Why are you freaking out about this? I would say, okay, well, let's look at another metric that is basically in line with that, that is relevant. So here is the SOFR rate versus the Fed funds rate. So I was just talking about, again, Fed funds rate is used to finance very, very short-term activities. The SOFR rate is also a very short-term activity. It's basically bank funding overnight between each other using a collateral. So basically like one bank posts collateral, usually treasury securities, with another bank, and then that bank gives them cash. And then that bank will use that cash over the course of literally one day in order to fund certain collateral requirements and cash liquidity requirements. And then over the course of that one day, they will send it back. And that's what they call the repo market, the repurchase market, or reverse repurchase market if you're doing it the other way around, where you say, I don't need the cash, I need the collateral, versus saying I need the collateral and I need the cash. So this is basically like a spread that shows basically how expensive it is to do those types of transactions. It's the SOFR minus the Fed's funds rate. So it's like, how much are the banks charging for this type of transaction versus the Fed? It only goes back to 2018 because unfortunately the information, the SOFR only started existing then. But here you can see like that's how it is. And it usually hovers around 0. But you can see like even getting to 10 basis points would be kind of high. 10 basis points would be a lot on this. It usually hovers very, very close to 0, 1 or 2 basis points, a handful of basis points. And then if it's positive, that means that people are straining to get that cash. They really need the liquidity. And you can see that in 2019, we had some crazy big spikes where it was spiking up. And this is a weekly average. We're looking at a weekly average. It spikes up to a pretty significant degree, 68 basis points. So imagine again, the Fed funds rate is at, well, in 2019, it was at like what? 2.5%, I think it was. Well, I mean, I guess I can zoom out, can't I? Yeah, 2.5%. It was at like 2.5% or something like that during this period right here. And then at the same time as that was happening, there was another 68 basis points essentially being demanded by the market. Oh, losing my tabs. So many tabs. Problem here. Shit, where'd it go? I didn't just delete it, did I? Man, where'd it go? Did I just close out of it accidentally? Oh, here it is. My bad. My bad. You lose track of them. But anyway, so the point is like 68 basis points over that for a 1-day loan is just insane. Now, one thing I'll also point out here is that in 2021, you'll see it went negative. And it went negative very, very substantially with 2022, and really only towards like the back half of 2023 did it start to get close to back to that 0 point. And what this really shows is a measure of liquidity, or the pricing for liquidity in the markets. When the pricing is high, it basically means people are desperate for cash. Desperate for cash. There's a lack of liquidity in the markets. And when it goes negative, it basically means that they're like, actually, we have too much cash. We have too much cash. We have too much liquidity, and we need to get rid of it. And that's basically what that shows right here. And so here you can see like for 2024, it was kind of about normal. We were kind of back to kind of a normal range where it's just bumping up and down a little bit. And it's fine if it has little bump ups like this. You can see these little bump ups. It's fine. It's not like a big deal. It's really about how long does it stay there. Like the size of the spread matters, but so does the length of time that you're in there. Because you can see like in these periods of 2019, it's not just that it's spiked up high. It's also that it remained above 0 for an extended period of time, for several months. For several months, it remained at a positive level. It didn't revert back to 0 over the course of a relatively short period of time. Like that's really the thing that matters, is not just the size of it, but also the length of time that it lasts there. And so with that context in mind, look at these last couple of months, really since September, like end of August into September, and then throughout October as well. You can see it's just been getting worse and worse and worse. And basically what this means is this is banks saying, we do not have enough cash. That's what it means. Like that's banks themselves basically saying, we do not have enough cash. We do not have enough cash to fund other banks' collateral needs. And so we're demanding a higher cost for it. And we do not have enough cash in order to fix the Fed fund rate to the exact level that you were trying to determine it to be. And what we're doing instead with that cash is that we are parking them in long-term treasuries because we're concerned about growth scares. We would rather sit in bonds because of growth scares rather than fund liquidity needs to the rest of the market, is basically what that means. So big concerning thing. And like, again, that's just a market measure of this, but there are other aspects of this. So when you're talking about the balance sheet, when we're talking about the asset side of the balance sheet, you gotta remember this is the assets, which means that there are liabilities as well. There isn't really equity so much to speak of for the Fed. It basically is just all liabilities, it's just assets and liabilities. But the point is there are different parts of those liabilities to take into account. So here is the Treasury General Account. This is basically the federal government's checking account. This is like their main operational fund. And you can see it goes up and down. They have to auction off a bunch of bonds in the market, and it builds up, and then they spend it down. They auction off a bunch of bonds and build it up, and they spend it down. It moves up and down. But you can see that over the last few months, we have been building up the Treasury General Account. It started really in July, but in the last 2 months where we've been having the liquidity strain, it has been a period of time where we've been doing that. And so you have to think about this. Again, this is a liability. So it is a negative to the balance sheet. And so if a negative to the balance sheet means that it's going down, and going down is tightening, then that means a buildup in the Treasury General account is a tightening of financial conditions. It is pulling liquidity out of the markets. It's basically like the Treasury saying, hey, all that financial liquidity in the markets, we need it to fund the government. So we're going to pull that out of the markets to go fund the government. So this is one thing that has been draining liquidity. They literally pulled $600 billion out of the financial markets over the last 3 months. Is basically what they've done here. Now, the plus side to that, I would say, is that we are probably near the end. You know, like it seems to be that the level at which they like to operate is like between 600 and 900 billion or so. So they're basically about at the end of it. In fact, they could probably start to spend some of this down, which would sort of be like releasing the liquidity back into the economy, because they would be spending it into the economy, and then the economy itself would probably bring it back to the financial markets in some way, shape, or form. So that's one thing I would say is like this is one of the reasons we've been having this liquidity strain, and it is probably coming to an end, that particular effect. But that's not the only factor too. So here is the reverse repurchase count for the Federal Reserve, and this is also a liability. So what this is, but this is a sort of a negative liability. That's why they call it a reverse repurchase. So technically, it sort of becomes like an asset. This is a place at the Fed where banks and other financial institutions can essentially deposit their money to the Fed when there is excess liquidity. So when I was showing you before the where is it? Can't keep the order in my mind which ones are which order here, but God damn it. Lost it again. This one. So I'm showing you here before this period here where you see in 2021 it went negative in 2022, and I was saying that means we have too much liquidity. There's too much dollars. There's too much money out in the financial system, and that liquidity is causing inflation and causing market bubbles and all that. And that this is the market pricing saying that. Well, if you look over at the repurchase agreements, once again, I can't remember which ones are in which orders. This is that same period of time. You can see 2021. 2022, and then about kind of like late 2022 into mid 2023, it starts to drain down. So it's that same period of time. It's like when they said, when the rate was saying, oh, there's too much dollars in the market. This is the banks themselves saying, yes, there are too many dollars in the market. Here, Fed, take the dollars back. Here, we're going to deposit those dollars back to the Fed, and the Fed pays them interest for it, and that's why they do it. They basically, it's like the Fed saying, hey, if you think you have too much money, come give it to us. We'll pay you interest. That way it's not causing inflation in the market. That's basically what they're doing here. Is they're basically saying like, hey, park your extra money here so that we can keep inflation from going out into the market. And then whenever you want that liquidity back, you can pull those deposits back out of the market. So as when rates were loose, inflation was high, money printing was high, there was too much money going in the market, then they parked a bunch of dollars here, and then the rates started going up, and then the balance sheet started getting sold off, and then liquidity started draining out of the system, and then the markets were like, hey, actually give us that liquidity back. And it's about $2 trillion worth that they pulled back out into the market here. You can see, and then as they slowed down the balance sheet runoff, and as they slowed down the interest rates, and then eventually started to lower interest rates as well, you can see that started to slow down. But here in the last few months, since about September, this facility has basically hit zero. It's basically bottomed out, meaning there is no extra liquidity out there for the markets to be able to tap. And so that's another factor that is causing this strain out there. Now, this next one is the reverse of this. Technically, these are the reverse repurchases. These are reverse repurchase agreements, and here are overnight repurchase agreements. So basically, like what a repurchase agreement is that when the institution goes to the Fed and says, hey, I need cash. I need cash right now. I need liquidity. I can give you these treasuries, these securities as collateral, and then tomorrow you can give me the securities back and I'll give you cash back. But I need cash today, right now. And so that's what the Fed does. It said, hey, sure, I will give them to you. You give us the treasuries. And that's what these are. These are showing how many treasuries are they holding in order to do that. Whereas this is the reverse of that. That's why it's called a reverse repurchase agreement. It's them saying, hey, I actually have too much cash and I would much rather have securities. I would much rather have treasuries. So would you give me treasuries instead and I will give you the cash? And so that's what this is. So this is literally like the inverse of this, where like this should be high when this should be low, and this should be low when this should be high. And in a sense, they're kind of like negative to each other. And so the reason why I point that out, because let's look at it exactly on 5-year scales, or actually let's use a 10-year scale. You can see that this was zeroed out here in 2019 during the period where we were having, where we were having the repo rate spike. So here I was saying, hey, there was major strains in liquidity, and people were saying, hey, I desperately need cash right here. We need liquidity desperately in the later part of 2019. And in the later part of 2019, you can see, yes, they were desperately posting collateral at the Fed in order to get cash. They're like, please, please, please give us cash. We desperately need it. At the same time, there was no excess liquidity in the reverse repurchase thing. And then here you can see now again, zero extra liquidity in the reverse repurchases. They're spiking up in the collateral needs. You can see like they're now posting collateral saying, hey, I need cash. As of Friday, we were at 50 billion worth of collateral has been posted to the Fed, where some bank is saying I need 50 billion of cash, which you can see it's not as high as some of these high levels of 70, 80, 100 billion in March of 2020 that we got it up to here, but nonetheless, it is way higher than it has been ever since then. So this is the things that people are looking at. This, like with the SOFR rate, I would say it kind of goes in the same vein where I was saying here, where it's not just the height that it gets to, but it's also the length of time that it's there that is indicative of strain. So looking at the reverse repurchases, we had like a little blip here, but it went away pretty quickly. So I wouldn't have been too concerned about this because it would have just been like a 1-day thing. Also a 1-day thing, but in September. Oh, another 1-day thing in September. Up in October, 1-day thing. Up, now it's becoming much more regular. Up, now they're literally not going away. Now it's actually climbing. So you can see like how it becomes progressively a bigger and bigger issue. And you can't see the same train back here because the facility only existed on more of like an emergency basis previously to this. Like they had used this back in 2008, 2009, and then they had revised the facilities and changed them out, and were using different types of facilities during this period here. And then in 2019, when we had that repo rate crisis, they used it to a much more significant degree. But then after the major money printing in 2020, they also kind of stopped using that facility for a variety of reasons. And then around about a year ago or so, or 2 years ago, they started allowing it to be a standing facility. So now they basically said, hey, anytime anybody actually needs this, you can just come and get it. We don't need to create an emergency facility for you. You can just come and get it when you need it. And then that's what we've been seeing in these last 2 months, as people have been starting to come and actually need it. So long way to say, I've just gone on and on and on about all these different things. I know it's a lot to take in, probably in a lot of ways, but because like I was asked the question, Jeff, I don't know if you were watching on the replay or anything like that. You sort of like did ask a little bit of a question related to one of my initial comments on it. And I sort of said something here, and it was admittedly not super clear. And I myself didn't say it super in fine enough detail, because I said, as expected, the Fed lowered Fed funds rate, but they also said they'll be ceasing reinvestment of agency security runoff and shifting it all to Treasury bills starting in December. And I said that this implicitly shifts us from modest quantitative tightening to easing. And then you followed up by saying that you don't like easing. It encourages risk taking, meme coins, no profits, low inflation wasn't a problem last time we had it, but now we do have inflation, so will it get worse? And I would say like those are all true thoughts, but I would say is like those things don't take a lot of these straining parts into account. It's like you have to realize that like the Fed's job is to moderate inflation, but their job is also to keep the financial system working. And so like right now, I think in the last 2 months, there has been some serious concerns that the financial system might actually be showing some cracks. I don't actually think that we're necessarily going to have a huge problem, because I do think, like, for example, as I just said, that they changed this facility around so that it's now a standing facility. So you can actually just come and get the liquidity if you desperately need it. So I actually think that those changes will actually help things improve a little bit. And I do think that the fact that they have been lowering the Fed funds rate is going to help improve that a little bit too, despite these little tremors in the Fed funds rate itself. And then also the both the long-term treasury has been coming down to a certain extent, as well as the dollar index has also come down pretty significantly over the course of the last year, which also supplies liquidity. And when interest rates come down, the exchange value of a currency also tends to come down further. So the dollar is probably going to come down even more, which is going to supply even more liquidity. So the point is, like, there's reasons to believe, I think, that this will start to improve over the next, I would say, 3 to 6 months. But in the very, very short term, it does take time for those things to filter into the system. So we're already straining now. We've been straining for the last 2 months. And so because of that, saying, oh, it'll be better 3 to 6 months from now ain't great, because we could, in fact, enter a situation where liquidity is completely dried up here this month. It could be like literally this month, and the next month could be potentially ugly if those things aren't alleviated. It may be fine. It may be totally fine. But the point is, it creates a scenario where that could create a snap, a little bit of a flash correction. And that kind of plays back into like what I was saying earlier with the sentiment and positioning tool, is that this is not a timing tool. This is more like a risk sensitivity tool. It tells you like what is the likelihood that you're going to correct to an even higher degree because people are caught offside, so to speak, when a correction happens. It doesn't tell you when the correction will happen. It just says how bad it could be if a correction happens. But one of the things that does tend to give you a better signal of when a correction is going to happen is liquidity strains. So that's what I would say, is that we are in a little bit of a delicate scenario currently with liquidity, and the Fed has been trying to police it and manage it as best as they can, while also trying to manage a lot of the political expectations that people have around them, as well as also still trying to manage the actual inflation scenario. Because this is the thing about the Fed. People talk about the Fed inflation, like, oh, the Fed did this and inflation got better, and the Fed did that and the Fed inflation got worse. The Fed affects inflation, but they don't create it, right? So going into quantitative easing and lowering interest rates does not create inflation. It just allows the inflation that already exists to come forth. What the Fed does, and I would actually say, like, if you really want like a very in-depth understanding of like how this stuff works, I would say actually go, I posted a video that talks about this in high depth recently. Here, Hoover Institution, Inflation by Hoover Institution, a talk by John Cochran, who in my opinion is one of the best economists alive, and he's an expert on inflation in my opinion. But he talks about it in high detail in that video, that basically like what the Fed does and like how interest rates affect inflation is, what it does is it kind of shifts the timing of when you experience the inflation to either sooner or later. That's basically what the Fed does. So like if they jack up the interest rates, that lowers inflation. But the way it does is it essentially it's taking the inflation that has already been created, that's already out there due to the money printing of both the commercial banking system as well as the Federal Reserve and the federal government, and then it basically squishes it into either sooner periods or later periods. So if you jack up the interest rate, you're going to have less inflation in the short term, but you're going to push that inflation out into the long run. And if you have low interest rates, you're going to have the opposite effect, where you're going to have more of that inflation up front, but then potentially you're going to have less of that inflation in the future. And that's how it works. But again, it doesn't create the inflation. So like Jeff, you had said there that, well, we had quantitative easing before, like specifically you'd be talking about like these periods right here. We had quantitative easing in 2011, 2012, 2013, 2014, all quantitative easing, but we didn't have high inflation during these periods here. So why didn't we do that? Why was that not the case? And the truth is that there wasn't large inflation at that point in time to have at that moment there. They had low interest rates and they had quantitative easing. The quantitative easing itself is going to create the interest rates, is going to help and create the inflation, but it's because it's the government spending. The quantitative easing is the government spending. So the government spending is going to create the inflation, but then they themselves had low interest rates. And then low interest rates are pushing that inflation out, or my bad, I had it reversed in my head. That pulls the inflation forward to the present. but it was right after a deflationary period of 2008 and 2009. And this deflationary period was then combined into the forward press of inflation due to the low interest rates here, which created lower inflation during the future periods of over here. But then we had a lot higher government spending during this period here, and also low interest rates yet again, which caused that inflation to be pulled forward here. So there's kind of like a mix between inflation now versus inflation later. And that's basically what I would say. So yes, they're potentially going back to quantitative easing, and yes, they're lowering interest rates. But as far as like the effect on inflation, I wouldn't really think about it as like the Fed's effect on inflation. Instead, think about like what is the federal government deficit, what is the deficit spending, and what is central commercial bank money printing. And for the record, central commercial bank money printing is sort of the good form of inflation because it's backed up by essentially like good investment in the economy, or what's perceived to be good investment in the economy, what will likely pan out as good investment in the economy, versus government money spending, which the vast majority of it is consumer spending. The vast majority of government spending is just consumption. It's just consumed. It's not real investment. There's some investment the government does, but it's not the majority. And so that's where you end up getting this big difference between the types of inflation, good versus bad. So yeah, long way to say that watch out. The markets are potentially going through a little bit of a topsy-turvy period. We had the rate cut, and then the market seemed to kind of react not necessarily super positively to that. In some ways, that kind of goes in line with that. And then there's also, the yield curve itself, which is kind of relevant to, I've been pretty bullish on the yield curve going up over time. And this is looking at kind of like an average yield curve, not even just a flat specific one. But I've been pretty bullish on this moving up over time. And I've been making the case this can be positive for FG in particular over time, especially into next year. But it does create also liquidity strains in the market when that kind of happens too. So that's another factor that I think could create essentially a long way to say that I think the S&P could potentially have some declines in the very near term future. Also could maybe not at all, because these are all just liquidity measures, things that don't have anything to do with, like I said, growth and expectations. So if earnings continues to be good, we could continue up through the end of the year. There's a lot of fundamental reasons to believe that the rest of the year will be fine. But valuation is high, positioning and sentiment is high, and liquidity is potentially a little bit concerning. And I'm focusing also on very US focus measures of liquidity, but it's also worth noting that technically liquidity can be measured on kind of like a US basis also versus like an international basis. It's like here, like if you combine the Fed balance sheet with the Treasury General Account with the reverse and regular repurchase agreements in together to kind of get an idea of like what is the net liquidity being supplied to US financial markets, you can compare that with S&P 500 weekly returns, which is what I'm showing right here. And this is also going back, it's worth noting, to the 80s. And so it's also worth noting that the strong correlation of liquidity with the S&P 500 really began after 2008. So you can see is like there's kind of like a somewhat positive correlation to the ebbing and flowing here, but the S&P 500, which is the blue, is much more chaotic. You can see here, but something happens in 2008 where suddenly like Fed liquidity supplied to financial markets becomes significantly more correlated with the blue line, which is the S&P 500. It's not a perfect correlation, and also this is an offset, so you can see like right here, the red line goes further because it's literally a 1-year offset, because really it's somewhere between 0 and 12 months that it takes for the liquidity to be supplied to market. So I kind of offset it by a year. There's some periods of time where it having no offset looks better, like in 2020. This period here would look a little bit better if the red line was shifted a little bit further to the left. So like that would be a little bit better if there was no offset. But then there are other periods of time where the offset makes it look even better. Like I would say it makes it look better in 2017, 2018, as well as 2008 and 2009. So it's like 0 to 12 months is kind of the lag period, but it's not a stable lag period. It's just some period of like 0 to 12 months that it takes for liquidity to enter the markets. And you can run regressions on this, and the stats actually do come out very strong. But again, this is US supply liquidity. So I kind of wanted to show like there are other aspects of liquidity to financial markets, like what's going on in the rest of the world. So like here, even showing this, you can see like financial markets have done really well going into 2024. But then here you can see in 2025, liquidity was recovering in 23, 24, which explains a lot of the outperformance in 23, 24 for markets. But then going into 2025, we've kind of been like dabbling with falling off in liquidity. Like maybe this will start to grow again, but maybe it'll start to shrink again. And that's kind of creating, I think, a little bit of a little bit of a mixed signal in terms of like where the financial markets liquidity is actually likely to go. But like I said, you can take this and do a more global version. So here you can see the blue line doesn't change, it's still the S&P 500, but now the red line, instead of being a Fed supplied measure of liquidity, it's now actually just the global M2 money supply, which is you can't get the same measures as the other metric for the other countries. So really, I'm just using the overall money supply as my kind of proxy for global liquidity. But here you can see also the pretty strong correlations. The correlations for this one actually is stronger going back even to 2000, though. You can see like this is very strong. Also a 1 year offset. You can see it's still a 1 year offset. And likewise, like I said, like there are some periods of time where that 1 year offset really doesn't match up. Like in 2008, 2009, the money supply growth was quite strong, but the global markets just fell off. And then eventually the correlation came back together after the crisis. So this is basically my long way of showing like why liquidity matters to financial markets. It's like we may not invest around liquidity measures, but it's a good idea to have an idea of like where liquidity is heading, so you can get an idea of why the market is crashing when it's crashing. You know, it's like if you understood that liquidity was declining over the last 3 to 6 months, both on a US basis and a global basis, and you knew that the positioning and sentiment was really, really high over the last like several weeks, and then the market just suddenly had like a 5 to 10% correction, well, then it really wouldn't be that strange to you that we had a 5 to 10% correction. It would actually be like, oh, this makes perfect sense that we had a correction. So like I said, none of these, all this stuff, these are all just cool models and stuff and ideas and about economic data and financial markets data that I've been playing with. Like I said, a lot of it is just for trying to understand what's going on. It's not like we're not investing based off of what any of these signals say. It's just trying to understand where we are and getting an idea of what could happen in the future. So yeah, that's my take on liquidity and what the Fed's doing. They are technically returning to easing, but I would say it's more like a financial market stability management kind of thing than a like inflationary thing at this current stage. In terms of whether or not it turns into an inflationary thing, I would say has to do more with what happens with the deficit, which, you know, is another thing I have been watching all year. But you know, I'm in here, I'll show you, yeah, this little chart where I've been looking at like the monthly budget deficits and comparing it with the as a percentage of GDP deficit numbers. But this also has not been updated since the government shutdown. You can technically go to the actual Treasury site every month, and even though we're in shutdown, they still post the monthly budget statement. But it's not being posted to the charting information on the Federal Reserve site. So I can't show you the updated chart here. But I am still going to the page and looking at it nonetheless. And so I'll actually get a new report of that in the next few days. But yeah, so I'm hoping to see improvement on that. We actually have had modest improvement in the deficit so far this year, which is good. And I think I would say that's good for inflation, but that's also a negative for liquidity. So it's one of those things where it's like one can be good for one thing, but it can be negative for another thing. So anyway, that's pretty much going to do it for today. We went for a long time. Like I said, I knew I had a lot of stuff I wanted to talk about today. I wasn't sure how much of it I was actually going to get into, and we really did actually cover most of it because, well, you know, I wasn't sure I was really going to feel up to going for 3 full hours, but here we are. So, but yeah, so it's fine. Not a lot of you guys came to chat with me today. Only Olga popped in for a moment. I think we had a few viewers in that were kind of listening quietly, but so I appreciate you listening. Anybody watching on the replay, I appreciate you as well. Please like, subscribe, all that jazz, and then look forward to my next stream, which will hopefully be within the next 2 weeks. Probably be talking a lot more about the results from a lot more of my company's earnings reports as they come in. So yeah, looking forward to that. Catch you all next time. Bye.